conference in Brooklyn, New York. One of the key topics here is regulation around tech. How should that continue to evolve? We have a wonderful guest to help us bring us up to speed on that. Mignon Clyburn, former FCC commissioner. Mignon, thanks so much for joining us here on Bloomberg Radio. One of the big issues, there's so many big issues from a regulatory perspective that I think all regulators around the globe are trying to get their hands around. But let's just start with privacy. There's that fine line, obviously, about privacy. Where do you think regulation is right now in the U.S., and where do you think it needs to evolve?
Well, again, it's a pleasure to be here, but it's in flux, and it's influenced by international pressures and international concerns, and it's also influenced by what's happening in the States. So what we're seeing now is a lot of people complaining because they are vulnerable. They're absolutely vulnerable. Every time you turn around, there's a breach. Every time you look, your information is being sold. So there are a lot of people around the globe that are feeling very vulnerable. And there are places, including the EU, that said, look, we think your information, that this is a human right, that your privacy is your right, your right to be forgotten. In the U.S., we come from a different point of view. It's more of a consumer protection, antitrust point of view. So what we're seeing is the U.S. is kind of sandwiched in between what is going on internationally, which is more aggressive, more from a human rights nature, and what's going on in Congress, which some would say close to nothing. Right. But others would say, there's a balancing act that we're trying to achieve that is very difficult.
So what should regulators be doing right now to get closer to the middle?
I think they should listen to the consumers, seeing what's going on in the States. Because what I fear and what a lot of people fear, if we're going to have 50-plus state approaches to privacy, to antitrust, to federal regulation, and that's a problem.
Well, but understood. But if consumers really are demanding that, why can't they just vote with their feet and not use the services or pay for certain services?
Vote with their feet and do what? They want services online. They want opportunities online. They want telemedicine. They want all of these conveniences that are happening online. And some people are making choices. They're making sacrifices, but they're making those sacrifices in an environment that will cause or could potentially cause long-term harm, because their information, their footprint, their digital footprint is all of this, is all of them. And once that is out there, if that is sold to the highest bidder, if it's more vulnerable, then you can't get that back. It's like your Social Security, your information online, you cannot get that back. So people are not going to go back to the 19th century in terms of their online and other the conveniences. They're not going to roll back the clock, but they do want to be protected.
So, Mignon, you mentioned Europe, and we have the GDPR over there, which I believe is the Global Data Protection. I'm not sure what the R is. But that's all about protecting users' privacy. How is that working over in Europe, and is that something we should think about here?
Well, it's been going on for a number of years, but things are still being implemented. They updated their privacy rules to give the individual more control. Again, they said this is your human right, your digital footprint is your right. It is absolutely yours. There's a right to be forgotten. There are a number of other things that are more progressive, and if companies violate it, there will be stiff penalties. In the U.S., it's not so much. It's more, again, of an antitrust, consumer-oriented framework. And there is a friction here between Congress, between regulatory authorities, that we need to do something, but the what? The right. Details have yet to be worked out.
I want to switch gears a little bit to net neutrality. I know that you've been a huge proponent of keeping net neutrality. We've seen Ajit Pai, the current FCC commissioner, roll that back or try to. What do you think the outcome of that is going to be?
Much of what we're speaking about here, there's going to be a 50-state approach, because even though net neutrality from a federal standpoint has been rolled back, states have the ability to create their own laws. And what the fear is that we're going to have a patchwork of net neutrality principles and laws, and it's going to be more difficult for online and other types of technology companies to do business in this nation. And so that's the fear I have.
How about, just real quickly, Mark Zuckerberg going in front of Congress? Can this industry police itself? I'm just thinking tech, not just social media, but just tech. Can it self-police, or do we need the government?
We need all of that.
Okay.
We need self-regulation. We need the government to stand up. We need Congress to institute fine principles, solid principles that everyone will govern by. And we need the states to be on the ground, looking out and listening to individuals and being a partner in the regulation. We need all of the above. I call it a regulatory gumbo because everything needs to be a part of that mix in order for it to work.
Mignon Clyburn, thank you so much for being here and joining us today.
My pleasure.
Mignon Clyburn is former FCC commissioner. Really interesting to hear the big debate, which is where do we want to be on this spectrum between having privacy as some sort of right and sort of catering to a capitalist model where that data is very valuable to a lot of the companies and they want to be able to use it.
Yeah, and it's interesting. It is different here than it is in Europe, and they've really have a much higher threshold for the value of privacy for the individual than we do here in the U.S.
For example, they don't think it's right if you have an embarrassing photo to be able to Google it, 10 years later and have it be pulled up.
Right.
So whereas here, go at it.
Right, exactly.
Coming up, we've got more from the conference. We're going to be speaking, including Robert Revkin, Compass founder and chief executive officer on some of the tech advancements in the real estate business. I'm Lisa Abramowitz along with Paul Sweeney. This is Bloomberg.
It's another Wednesday afternoon, yet another windy day. So ditch the British winter and chase the sun across the globe with British Airways from London Gatwick to see spectacular coral reefs and white sand beaches. Fly from London Gatwick to Mauritius with British Airways, with flights and 7 nights hotel from just £949 per person. Don't miss out. Book by November the 12th at ba.com/wintersun. With British Airways, incredible is within reach. Booking fees and conditions may apply. Limited availability. Selected flights in March.
Hey, it's me again, the TV. Since my family gave me Now TV, there's no more endlessly searching for something they want to watch, because now I don't do filler TV, just killer TV. If my family want horrors, no problem. It's not real, it's not real, it's not real. Reality TV, I can fill that island-shaped hole. Or how about comedy? Coming up, way better than the dad jokes in this house. Now they can watch whatever they're in the mood for.
What's your TV got for you tonight? Now TV. 18 plus, month passes auto-renew, terms apply.
Bloomberg World Headquarters in New York, I'm Bob Moon. A State Department Foreign Service officer is telling House impeachment investigators that former National Security Advisor John Bolton cautioned him that Rudy Giuliani was a key voice with the president on Ukraine and could complicate U.S. goals in the Eastern European country. The testimony today from Christopher Anderson makes clear that administration officials were concerned about Giuliani's back-channel involvement. Officials say a new wind-driven wildfire in Southern California near the Ronald Reagan Presidential Library has grown to more than 400 acres since it started just before dawn. The Ventura County Fire Department says the fire is being fanned by strong Santa Ana winds. If the flames are kept back from the Reagan Library, John Hubish, executive director of the Reagan Presidential Foundation, says they have the goats to thank.
They're able to keep the brush down to a minimum. It's terrific to have them out here. Tourists come to see the goats eat away, and they did their job last year, so I'm sure that's a great help to us right now.
Mandatory evacuations have been ordered around that fire northwest of Los Angeles. A forensic pathologist hired by the family of disgraced financier Jeffrey Epstein says some evidence suggests Epstein may have been killed rather than dying by suicide as per an official ruling. Epstein was awaiting trial on sex trafficking charges. Dr. Michael Baton told Fox News he had concerns about the New York City Medical Examiner's findings.
I was asked by the brother, the next of kin, to be at the autopsy. And at the autopsy on day one, there were findings that were unusual for suicidal hanging and more consistent with ligature homicidal strangulation.
The medical examiner said today she stands firmly behind her findings. Global news 24 hours a day on air and TikTok on Twitter, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Bob Moon, and now your latest business headlines. Here's John Tucker.
All right, thanks, Bob. And as we look at the major stock indices, pretty quiet ahead of the Fed meeting today. Not a lot of movement in U.S. stocks. Investors waiting for that rate decision from the central bank. The Fed widely expected to lower rates for a third time this year. Tony Crescenzi is a portfolio manager at PIMCO.
Markets looking at the Fed, and the Fed's looking back at the markets, and they have to mirror what the markets are doing. So the probability of what the markets have in for a hike is 90%. That's too high for the Fed to say no today.
Now, for investors, the tone of Chairman Jerome Powell's press conference later in the day is going to be key to ascertaining the trajectory of policy heading into 2020. Pizza Hut's parent Yum Brands posting quarterly sales that trailed Wall Street estimates. Now, that has sent the shares tumbling today. Molson Coors Brewing, they disclosed plans to cut as many as 500 jobs and close an office in Denver, where it moved just a few years ago. S&P 500 right now unchanged. We're at 3,036. The Dow Jones Industrial Average up 30 points. That's a rise of 0.1%. We're at 27,102. The Nasdaq Composite Index down 6 points at 8270. 10-year yield in the U.S. 1.80% as the price increases by 9 seconds. Now we have NYMEX crude down 98 cents a barrel at 54.55. And we check the markets for you every 15 minutes during the trading day right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash.
This is Bloomberg Markets with Lisa Abramowitz and Paul Sweeney on Bloomberg Radio.
So, Paul, we've been hearing a lot at the Sooner Than You Think conference here in Brooklyn about the issues with people's use of Facebook and Google and other things. There is a question, how does the Internet want to be policed? And luckily we have with us Michael Beckerman of the Internet Association, which is a company, an association that represents the tech companies, app providers, etc. Michael joins us here. Thank you so much for being here. I'm just wondering, how the industry responds to some of the criticism that we're hearing, concerns about privacy or bots or other things like that.
So first, I think it's important to recognize the overwhelmingly positive impact that this industry and our member companies have both on the economy, national security, economic security. This is a top export that we have in the United States, and certainly there are issues that we need to address. Our members have been on the forefront on pushing for comprehensive privacy legislation that will protect all Americans online and offline. And we're looking for solutions to some of these very, very difficult problems that we have. And the issues that we're dealing with as a society are not just online. It's questions of speech and democracy and things that are on and offline. And I think our companies are up to the challenge. We're working very closely with policymakers at all levels on these issues.
So, Michael, over the course of, I'm going to call it the 25-year history of the Internet, broadly defined, the U.S. has taken a very light touch. That's my opinion, my analysis. A relatively light touch relative to, say, Europe. Is there an understanding within Silicon Valley and within the tech community that is changing, that now the U.S. regulatory apparatus, whether it's states or federal government or agencies, are really looking at tech in a much different way?
Absolutely. They're aware of that, and they welcome it. And as we were talking before during the break about the number of CEOs that have come to testify and are open to work with lawmakers. But as you mentioned, the regulatory landscape here in the United States and a lot of the rules, and there is regulation versus in Europe. I mean, how many global European internet companies can you name?
Right. I mean, so there's that balance, obviously.
There's that balance. I think it's a huge benefit for us as Americans to have these companies that are all global companies, largely based here in the United States with all the economic value and jobs and all the positive things that come along with it, based here in the U.S. because they really could be anywhere. And now as you look at the Internet is very much global. Most of the users are not in the United States. And so we want to make sure that there is regulation and it's done right so we can keep that here and keep the innovation here.
All right. So we were talking earlier and you said that there are good actors and bad actors. What are the good actors trying to do to sort of root out the bad actors?
It's difficult. When you look at the bad actors, you hear about the 8chans of the world, and you look at a number of companies that are content moderation and speech and all these other things. But these we're fortunate to live in a society where we can have open conversations and see what's going on with these companies and work with policymakers to make sure that we're all getting it right. But again, one of the great things about the internet is, people get to have a lot more control or power over their experience versus in other sectors of the economy.
Wait, hold on a second. Please explain. How do you have more control on the internet than in other places?
The user is king or queen. You can decide which service you want to use. You can.
Wait, hold on a second. In fairness, we've just been talking to all these people who say that the consumer has no power because they're basically there's this contract implicit in some of these free services that basically you're giving up your data and your privacy in order to get Facebook or whatever else.
Sure. You can choose to use it. I mean, as you know, I don't want to say it, but if you're not happy with Facebook, there's nothing holding you to keep using Facebook. You can use any other services or not use it at all. I don't think that same ability of an individual exists on other platforms. And additionally, as you look at the changes that they've made, in particular, other companies have made, like take privacy, for example, which I'm going to be speaking about shortly. Consumers are demanding more privacy protections. They're demanding more transparency over privacy policies. And so where else do you have, as an individual, as much control and transparency over the privacy tools than you do on internet companies that we represent? Think about how many times a day you get mail to your house, an advertisement with your name and address, personal ad that is coming in mail form. Where is that coming from? That's largely coming from things outside of your control in the offline world. And when you look online with all the services now, they have very granular and transparent privacy tools that you can use as you see fit, or not use the service at all. And so I think that there is a lot of control for people online that doesn't exist offline.
I think one of the concerns or one of the criticisms is, obviously the regulators are way behind where the technology is. Nothing new there. That's pretty consistent. But the criticism of Silicon Valley of tech is that this whole concept of data integrity, data privacy, this is something that should have been at the forefront of the development of some of these technologies, whether it's social, whether it's search, and it wasn't. And now the tech guys, they're playing catch up as well, and then now the question is, what is the solution? I mean, it can't just be a regulatory solution. It's got to be something bigger. And I think a lot of people are just searching for, okay, Mark Zuckerberg or the good friends at Google, what are you guys going to do here?
Yeah, so first, for us, we want to see a national privacy law. California has enacted something. They're looking to do another ballot measure. We think that there should be...
It's another Wednesday afternoon, yet another windy day. So ditch the British winter and chase the sun across the globe with British Airways from London Gatwick and witness luscious scenery and calming waves. Fly from London Gatwick to St. Lucia with British Airways, with flights and 7 nights hotel from just £739 per person. Don't miss out. Book by November the 12th at ba.com/wintersun. With British Airways, incredible is within reach. Booking fees and conditions may apply. Limited availability. Selected flights in March.
Hello? This is Dustin. I found something. Is anybody there?
We hear you, Dustin. With Sky Q, you can easily catch up on epic Netflix shows like Stranger Things and then watch award-winning Sky originals like Chernobyl. Get Sky and Netflix all in one place on Sky Q for one surprisingly low price. Just £25 a month. Visit sky.com and join today. Offer ends November 14th. 18-month minimum terms. Prices may change during contract. Requires Sky Q box connected to broadband. Set up from £20. Further terms apply.
Now the 3-1. And Springer hits it in the air, deep to left field, and you can kiss it goodbye.
MLB fans, you can hear every call of the 2019 World Series on TuneIn Premium.
And that ball's hit well. Left field, high and deep. That's got a chance. Score!
The action concludes today with a winner-take-all Game 7. Will the Houston Astros or Washington Nationals be crowned as World Series champion? Listen live at 8 Eastern to find out. The 2019 World Series is on TuneIn Premium.
Hi, this is Brian Weber, host of NFL First and Goal every Sunday, kicking off at 1 Eastern only on TuneIn Premium. Be sure to listen this Sunday for the ultimate football fan experience, featuring 7 hours of commercial-free coverage of every scoring play around the NFL.
With any technology, it's not necessarily good or bad on its own. It's how people use it, and certainly, you can go through and look at the negatives that exist exists in social media or online or offline, but there's also a lot of positives. There's ways where people are being able to be brought closer together. Communities are brought closer together. There's a lot of positives that exist also, and I think it's a question of all of us as a society of figuring out how we want to use these tools and what's best for individuals and how they use it. So I don't think it's necessarily fair just focusing on the negatives of the shallowness maybe of some of the way people are using the platforms. There's a lot of positive as well.
So, Michael, one of the things that's a real challenge, we had the Chief Internet Security Officer from Equifax. CISO from Equifax. And he was talking about the challenges of kind of managing all the hacking capabilities of bad actor states, whether it's China, North Korea. What do we do there? I mean, if you're Facebook and Amazon, boy, that's something that I'm not sure how you solve that.
Well, certainly it's an arms race, and when you look at it, you're asking companies to defend against what is also often a state-sponsored attack. And if you think in the analog world, what would we say if one of these countries, deployed troops to a factory in Michigan or something? Would you expect that factory to have a certain level of defenses against a nation state that's attacking it? And that's what's happening online. But part of it is, again, you want people to be able to have choice and to say, who do I trust with my data? Who's going to be responsible? Who's going to make sure that they're defending against it in the best possible way, even when it is against state-sponsored actors? And our companies are fighting this battle every single day. But again, you mentioned, a company like Equifax, if they're not being responsible with your data, you're stuck. I never signed up for that service in the first place, and they've lost all my information all over the place. And I think that's a problem.
So I want to, when you go back to the bad actor idea, you mentioned other nations. Are there U.S. bad actors or companies in the United States that are doing some of the same types of behaviors?
In terms of cyber attacks?
Or whatever you consider to be bad actors.
Yeah, I mean, you look at, companies like, the 8chans and the back pages, and these are bad actors. Some of them are able to be, have their businesses overseas or something, but again, you need to have a mix of regulation and transparency for people to make the right decisions and laws in place that allow the good actors to defend and do what's best for their users, and then be able to punish the bad guys too.
Michael Beckerman, thank you so much. Michael Beckerman's from the Internet Association, giving us his thoughts on, as he represents the internet companies, the internet industries, as they face some of these issues about privacy and about data integrity. It's obviously it's a huge issue for society, and it's not limited to the internet companies themselves, I guess.
Well, to me, it really gets down to this fundamental issue, which is there is an implicit contract in using a service like Facebook, using a product like Facebook, where you are knowingly giving away the data that you generate. So the question is, should there be a larger kind of oversight in how the data is used and just a collection of that data, or is it incumbent upon each person to decide whether or not that's a contract they're willing to enter into before they use the site? And I think that this is sort of one of the fundamental debates at the heart of a lot of the issues that we've been talking about throughout the morning.
And I think Mignon Clyburn, from the former FCC commissioner, probably had it right when she said it's probably a little bit of everything. It's consumer behavior, consumer responsibility, obviously, then at the internet level and so on.
Right, but it's a sliding scale, and it's an interesting question, and I think that there's also another question of how much companies be doing to mitigate some of the harmful effects, and sort of what is the right model for how to use this data in a responsible way and not to foster something that is nefarious. I don't know. A lot of really little profound issues that are certainly at the forefront as we hear, and we take these hearings in Washington, D.C. We heard from Mark Zuckerberg, and we will continue to discuss this as we broadcast live from the Sooner Than You Think conference in Brooklyn. I'm Lisa Abramowitz, along with my co-host and colleague Paul Sweeney. This is Bloomberg Markets.
This is a Bloomberg Pursuits look at luxury. French are coming for America's jeweler. LVMH has offered $14.5 billion for Tiffany in an unsolicited bid that could result in Chairman Bernard Arnault's biggest ever takeover and expand the Louis Vuitton owner's reach into the U.S. A deal for the jeweler would expand the French company's access to U.S. luxury shoppers, giving it an iconic 182-year-old brand, and round out a stable that includes the Bulgari jewel and watch label, Christian Dior fashions, Hublot watches, and Dom Perignon champagne. In Hong Kong, a rare 1950s Patek Philippe timepiece is coming up for sale to tap Chinese collectors, the world's largest market for Swiss watches. The 18-karat pink gold Gabi Patek Philippe has a rare translucent blue enamel dial. Its price estimate, $7 to $14 million, is the highest for any wristwatch offered at auction. Visit BloombergPursuits.com for more. I'm Andrew O'Day, Bloomberg Radio.
Full breakfast, cup of coffee, whatever you have in the morning, have it at daybreak.
What's the outlook for the pound if there is another election?
Nathan Hager.
The U.S. could still delay those tariffs?
And Karen Moscow.
It is the fifth major industry player to make some sort of zero commission offer.
Bloomberg Daybreak.
Bloomberg has more from Hong Kong.
Weekdays at 5 a.m. Eastern on Bloomberg Radio, the Bloomberg Business app, and BloombergRadio.com. Bloomberg, the world is listening.
Adopt US Kids presents What to Expect When You're Expecting a Teenager. Learning the lingo.
GOAT, G-O-A-T, acronym, stands for Greatest of All Time. As in, spaghetti sandwiches for dinner? They're my fave. Dad, you're the GOAT.
You don't have to speak teen to be a perfect parent. Thousands of teens in foster care will love you just the same. Visit adoptuskids.org. Brought to you by the U.S. Department of Health and Human Services, Adopt U.S. Kids, and the Ad Council.
Rich is just a really good guy. The term good egg isn't enough to describe him. He's also certified organic and free range. Rich puts the cap back on everything. The toothpaste, the olive oil, the shampoo, everything. He lets his 10-year-old nephew beat him at virtual tennis, even though he can straight up slay his 10-year-old nephew in virtual tennis. When the toilet paper is running low, Rich replaces the roll on the actual holder, not just on the back of the toilet. Rich is texting and driving. Rich? No. What are you doing, Rich? I was just telling everyone how great you are. Texting and driving makes good people look bad. Visit StopTextStopWrecks.org. A public service announcement brought to you by the National Highway Traffic Safety Administration and the Ad Council.
From the financial capital of the world, 24 hours a day at Bloomberg.com, on the Bloomberg Business app, and at TikTok on Twitter. This is Bloomberg Radio. This is Bloomberg Markets with Lisa Abramowitz and Paul Sweeney.
Are we on the brink of a more serious downturn?
I've always thought of the municipal bond market as a little bit of a safe haven.
Banks are going to have to start paying their depositors more.
Are we still in that mode where we're buying the dips?
Breaking market news and insight from Bloomberg experts.
Cash, if you're looking at Treasury bills, provides a higher return than stocks and bonds here in the U.S.
If your consumer is a woman, you're more likely to be a growth company.
Longer-term interest rates can go down, even with short-term interest rates still going up a little bit.
This is Bloomberg Markets with Lisa Abramowitz and Paul Sweeney on Bloomberg Radio.
We are broadcasting live from the Sooner Than You Think conference in Brooklyn. We will have the Compass founder and CEO, which is a real estate technology company. We'll chat about that company and tech in real estate. Plus, we will preview the Fed result, which we expect at 2 p.m. But first, let's go to Charlie Pellet for a Bloomberg Business Flash. Charlie,
hi, thank you very much, Paul Sweeney. Here's what's going on. We have got U.S. stocks trading mixed. The Dow higher, S&P, NASDAQ, they are both lower. That Fed decision coming up sooner than you think, just under an hour from now. Investors, meanwhile, digesting the latest batch of earnings ahead of the latest Fed meeting. 1 hour away from an expected rate cut. We will have that decision for you live right here on Bloomberg Radio, 2 p.m. Wall Street time. And, of course, Fed Chair Jay Powell's news conference coming up at 2:30 Wall Street time. Catherine Rooney-Vera is head of research and strategy at Bulltick.
The Fed is going to cut rates because the market so demands. Anytime the market is pricing in more than 60% probability of a Fed cut, the Fed has not failed to deliver.
And on this Fed Wednesday, lots of economic data. Economic growth did slow in the third quarter, expanding at a 1.9% pace. Household spending offset weakness in business investment and exports. Payroll provider ADP said businesses added 125,000 workers in October, topping the prior month's gain. Services led the increase. Small business hiring moderated. And the Treasury says it is considering the sale of 50-year bonds as the budget deficit widens to $1 trillion. Bond dealers shrugging off an earlier Treasury proposal. Apple reports after the closing bell. Analysts are looking for adjusted earnings per per share of $283 on revenue of $63 billion. Also after the bell, Facebook analysts looking for adjusted EPS of $2.27 on revenue of $17.34 billion. So again, it is a mixed day for the U.S. stock market. We have got the Dow higher, S&P, NASDAQ. They are both lower. 102 on Wall Street. Time now for the Market Drivers Report. And with a focus on American depository receipts, here is Dave Wilson.
Thanks, Charlie. ADRs are lower along with U.S. shares. The S&P ADR index is down 0.1%, and the S&P 500 is also lower by about 0.1%. European bank ADRs are down in response to disappointing third quarter results. Deutsche Bank has dropped 6.3% in U.S. trading. Credit Suisse has fallen 1.9%, and Spain's Banco Santander has lost 3.7%. PetroChina has declined 4.4%. The oil producer's third quarter earnings and revenue were well below analysts' average estimates in a Bloomberg survey. PetroChina was hurt by lower oil prices and falling profit from refining and chemicals. Now, Japan's Sony has climbed 3.2%. The electronics maker's earnings for the fiscal second quarter were well above estimates. Growing demand for smartphone camera image sensors helped Sony overcome weakness in its video game business. And Luxembourg-based Ternium has gained 4.5%. The South American steel producer reported third quarter earnings that topped projections, even though sales fell more than analysts expected. Charlie?
And we thank you very much, Dave Wilson, following those American depository receipts. So again, recapping here, it is the Dow that is higher, S&P, NASDAQ both lower. The Dow up 27, S&P down a point, NASDAQ lower by 10 points. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thank you so much, Charlie. It is Fed Day Wednesday. We are expecting the Fed to cut rates by 25 basis points, quarter of a percentage point, and we are expecting them to indicate that they're going to pause, not necessarily do that much more. Some people, including Andrew Brennan over at National Alliance, saying that this is a pivotal week, could potentially paint a picture going forward that is pretty significant. Other people saying it's going to be another boring meeting where they don't say much. Vince Signorella joining us now, global macro strategist for Bloomberg. Vince, what are you expecting?
I'm in the mad camp, to be honest. I think the markets have this baked in. We will see a 25 basis point cut. Not because it's going to help the economy, just simply because it will harm nothing. And the markets will get their expectation, and it won't disrupt anything. But I think the key thing to look for is to see if we lose the phrase mid-cycle rate adjustment, which would put us on that pause trajectory, make us very data dependent, and have the Fed funds futures for December priced correctly at only 20%, looking for another Fed cut for this year.
So, Vince, if we do get that, I guess, body language about a pause, I mean, does that take us mid-2020 in terms of timing, maybe?
To be honest, it could take us to infinity and beyond. I mean, there's not necessarily a reason for the Fed to cut. We saw GDP beat this morning, really nice back behind that personal consumption numbers. I don't think the Fed will actually stress a pause as much as that will be implied. I think they will simply stress the data dependency version of the statement and just sort of bring us back to the middle. Now, the markets may take that as a hawkish cut. Doesn't really exist, but that's the way that people sort of talk about it. And in that sense, we might see a little bit of a kick lower in equities after the announcement, a little bit bump in the dollar and yields, but I don't think it'll last.
So, it's interesting. I'm looking at the dollar, and I remember there was once upon a time when people were deciding whether the Fed should do one thing or another based on the effect on the dollar. We have seen the dollar off its annual highs, but how much do you think that's going to factor in, and how will the dollar respond to what we're expecting, which is a Fed rate cut and then hold?
The Fed won't really care much about the dollar per se. I mean, the only time the Fed looks at currencies is if there is a lot of chop and they do something to sort of smooth that, or there's a very decided trend which is having a very negative impact on the economy, such as a massive drain on the current account. In this case, the dollar is not really in the conversation, I think, with the FOMC. But if they cut and give us that pause signal, we could see a bounce in the dollar. I just don't think long term it's going to hold up very well.
So, Vince, even though I describe you as a grizzled Wall Street veteran, I'm not implying that you're old or anything, but you've seen a thing or two.
Just a few.
Where do you think we could get surprised on the downside here? I just think people were really, really calm and copacetic going into this meeting.
Yeah, I think if I were an algo quant writing a program, which I'm very far from, I would be looking at the dissenters, and I think that's the surprise. How many Fed officials are not on board with this cut, and for what reason? You'll see the more dovish camp that say maybe they should be teeing up something bigger, and then the hawkish camp, which I think is going to be more in the majority. Will there be one more added to this group? That is the factor I think that's going to be the real surprise.
Vince Signorella, macro strategist for Bloomberg, thank you so much for being with us on this Fed Day. You will catch it live here on Bloomberg Radio or Bloomberg Television. We have a Fed special where we'll go over all of the details of the release, plus air live the news conference where it should be pretty interesting. We are broadcasting live from the Sooner Than You Think conference in Brooklyn, and I got to say,
it's lunchtime.
It's lunchtime, so you can probably hear in the background that it is lunchtime. But I will just say a lot of really big, important questions, Paul, that I'm going to go home and think a lot about, frankly.
Yeah, exactly. And I think one of the things that was framed very nicely is just kind of the business model of a lot of these companies, whether they're advertising driven or e-commerce driven, are not necessarily conducive to some of the other social issues that we hold valuable, such as privacy, such as data privacy. And so, it's an interesting way to think about it, but the industry in a very difficult position. I think society's in a very difficult position about what's the right balance there. I guess that's probably where the answer might lie.
The other interesting thing is we often have guests on who talk about artificial intelligence and how they're culling data in order to make consumer advertising or just a selection in terms of search more targeted and cater to you better.
Right.
And I guess there's also that sort of push-pull of convenience versus disclosure. I mean, we even remember the person we were speaking to about the data collected by sports stadia.
Yes.
Stadiums, how basically they're collecting data on where you shop, or if you potentially have an allergy, or if you have children, and then they will target your search results based on that. Is this good? Is this bad? Still, people are observing you and it's surveilling you. So, a lot of the sort of cutting edge technology is hinged on the accessibility of this data that can only be collected with a pretty small filter in terms of what can be collected. Right. So a lot of really interesting questions at a time when I'm absolutely terrified for the influence that I am exerting on my children as they look screens.
Facebook and Apple reporting after the close tonight. Facebook up over 40%, Apple stock up over 50% this year. So I mean, the business models are working.
Well, and this is the issue, right? As we were talking to Minion Claiborne, saying people are very concerned. They don't want to have their data accessed. Actually, they don't seem to be concerned enough to be quitting Facebook or quitting Instagram. They don't seem to be concerned enough to stop entering into this contract. So does that indicate that perhaps they're okay with it, or does it indicate that this is sort of a new social strata, and if you bow out of it, you are excluded? And it sort of goes to the whole Tristan Harris issue of, are you creating a tobacco-like situation where it changes the way people think? But
that's a tough analogy, but it's probably pretty accurate.
He did make this analogy. I think it was off air, but a really compelling look at a lot of the major means of communication today.
Exactly. So we've made that contract. It seems like most people have made that contract, willing to give up a certain amount of privacy in order to receive all of the wonderful services that these apps bring. And again, we're going to hear from the tech companies after the close tonight. Got a couple big ones again. Facebook reporting after the close, Apple reporting after the close. We'll have that analysis coming up on Bloomberg. This is Bloomberg.
Directors of companies are responsible to boards.
Let's begin with the IPO that may not be for a long, long time.
Politicians are mindful of voters.
Are those gains all going to the elite?
Scholars pay attention to data.
Does it spread beyond manufacturing?
And nearly everyone at the top of these professions listens to Bloomberg Surveillance.
Everybody listens when I'm on your show.
Tom Keene and Jonathan Farrow. Weekday mornings at 7 Eastern on Bloomberg Radio, the Bloomberg Business app, and BloombergRadio.com. Bloomberg, the world is listening.
Hi.
Hi, I'm Danica Patrick. Watching my nieces grow, play, and learn is amazing, but not every child gets to be carefree. 1 in 6 kids in the U.S. are hungry. This breaks my heart, and it's something that Feeding America is working to change. Each year, the Feeding America network of food banks rescues billions of pounds of good food that would have gone to waste and gives it to families in need. To help, visit feedingamerica.org.
Brought to you by Feeding America and the Ad Council.
What if you could keep the top economic experts in a conference room next to your office without having to feed them?
Do we need better optics? Do we need some substance?
Do CEOs care about ESG?
We have seen quite a lot of stimulus pumped into the system already.
It's the biggest warning yet about the financial risks of climate change.
Now, there are more ways to hear us. Bloomberg Radio, the Bloomberg Business, Radio.com, and iHeartRadio apps, and at BloombergRadio.com. Bloomberg, the world is listening.
When you went car shopping, you meant business. You aced vehicle history searches and test drives. You out-salesmaned the salesman. Now you've got your wheels. If you manage that, you can get your retirement plan on track. Visiting aceyourretirement.org can help. With 401k tips and smart saving strategies, you'll have the info you need to get more for your future. Go to aceyourretirement.org, because when it comes to speeding past financial challenges, you're an ace. Brought to you by AARP and the Ad Council.
It's another Wednesday afternoon, yet another windy day. So ditch the British winter and chase the sun across the globe with British Airways from London Gatwick to enjoy a warm Bayesian welcome.
How are you doing? Enjoying the sunshine?
Fly from London Gatwick to Barbados with British Airways, with flights and 7 nights hotel from just £699 per person. Don't miss out. Book by November the 12th at ba.com/wintersun. With British Airways, incredible is within reach. Booking fees and conditions may apply. Limited availability. Selected flights in March.
There's something for everybody this Halloween at Aldi. Dead good sweets, decorations, face paints. Be afraid. Be very afraid to miss out on these shockingly low prices. In store now. Everybody get to Aldi for an amazing Halloween.
Halloween's back, alright. Hey, it's me again, the TV. Since my family gave me Now TV, there's no more endlessly searching for something they want to watch, because now I don't do filler TV, just killer TV. If my family want reality TV, I can fill that island-shaped hole. Documentaries, I got ones about space, sharks, or superstars. Or how about crime dramas? I've got loads, and they're never gonna guess who did it. Now they can watch whatever they're in the mood for.
What's your TV got for you tonight? Now TV. 18 plus, month passes auto-renew, terms apply.
The nights have started to draw in, and at DFS we know that can only mean one thing. Everyone's spending more time at home getting nice and cozy. You can't beat it. That's why our autumn-winter collection sofas are handmade to order for complete comfort, and many are guaranteed to be delivered in time for Christmas. So make sure you come home to a sofa that's perfect for you. DFS.
The Peugeot Professional Van range is the beating heart of businesses across the UK. Whether you're on the road with only your DAB radio for company or navigating tight spots with rear parking sensors, all Peugeot Professional Vans give your business that edge. Visit your local Peugeot dealership during our October van event from the 10th to the 31st of October and drive away with an exclusive finance offer. Master the impossible. Peugeot Motor Company PLC is acting as a credit broker, not a lender. Finance subject to status. Terms and conditions apply. Business users and over 18s only. Guarantee may be required. PSA Finance UK Limited.
Now the 3-1. And Springer hits it in the air, deep to left field, and you can kiss it goodbye.
MLB fans, you can hear every call of the 2019 World Series on TuneIn Premium.
And that ball's hit well. Left field, high and deep. That's got a chance. Score!
The action concludes today with a winner-take-all Game 7. Will the Houston Astros or Washington Nationals be crowned as World Series champion? Listen live at 8 Eastern to find out. The 2019 World Series is on TuneIn Premium. Hey NFL fans, can't watch the game? Can't be there? No biggie. With your TuneIn Premium membership, you have unlimited access to every team and every game in the league. Listen live as it happens or on demand. Anytime, anywhere. All season long. Search NFL today.
Upgrade to TuneIn Premium and get over 45 commercial-free music stations. You'll also get live commercial-free news, plus live play-by-play games from NFL, MLB, NBA, and NHL. Visit TuneIn.com/premium to upgrade.
The swagger of a perfect dunk. The rush of a three made from all the way downtown. The adrenaline surge of great defense. Can you feel the goosebumps yet? There's nothing like live NBA and nothing like listening live on TuneIn.
Giannis down the lane to the rim, going right corner three. Another one.
TuneIn Premium brings you every minute of the NBA season, so you can be there when it matters most. Never miss the action as it happens. Hear the ball you love. Hear it live on TuneIn. Search NBA today to start listening.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at TikTok on Twitter. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We've got 43 minutes to go ahead of the Fed decision with the Dow higher, S&P, NASDAQ, both lower. Complete coverage coming up right here on Bloomberg Radio. Right now, the S&P down 2 at 3,034. That's a drop of about 0.1%. NASDAQ down 11, also down 0.1%. The Dow on the plus side, picking up 19 points now, up by 0.3%. Apple and Facebook check in after the closing bell. Right now, Apple is down 0.4%. Facebook lower by 1%. West Texas Intermediate crude oil slumping 1.4%, 54.75 a barrel. Gold up 0.4%, 14.94 the ounce. The 10-year up 10.30 seconds. The yield 1.80%. Again, recapping U.S. equities, they're mixed. The Dow higher, S&P, NASDAQ lower, S&P down 2 points, down 0.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
You're listening to Bloomberg Markets with Lisa Abramowitz and Paul Sweeney on Bloomberg Radio.
We are broadcasting live from the Sooner Than You Think conference here in Brooklyn. Technology. How is it disrupting? How is it adding to industries? It certainly is impacting the real estate business. To get a sense of how that's developing, we welcome Robert Revkin, Compass founder and CEO. It's a real estate technology company. They raised more than $1 billion so far. Robert, thanks so much for joining us. Let's just start off by saying what your company is and does and how you're changing the real estate business.
Yeah, so Compass, we're building a single technology platform for real estate activities, particularly for our agents, but also their buyers and sellers. We want agents to come here to grow their business. They're all small business owners, all entrepreneurs. Their buyers come to find the best inventory, and their sellers to sell their home for more money in less time.
How do you make money?
So we, the same way that Uber works with drivers as independent contractors, we charge approximately 20% of what they make. We have a similar model. All agents are independent contractors. We charge a certain percentage of their gross income.
So give us a sense of kind of the growth of your business. How, in terms of, I don't know, what are the metrics that you look at for growth?
We're in 105 cities.
Okay.
We have almost 14,000 agents. This time last year we had around 3,500 agents, and so we're growing about 3 times year over year. That's one metric, and then also number of cities and overall revenue. Our revenue this year will be over $2 billion, and last year was just a little over $800 million.
So before we get into some of the newer technologies, I'm going to talk about your favorite topic to talk about these days. It's SoftBank and how they are an investor in your company. And I know that you've been very vocal recently about drawing distinctions between Compass and WeWork, another SoftBank company or investor, big investor being SoftBank. Can you please explain?
Yeah, so I think WeWork is more of a governance and CEO issue than a business model and investor issue. Our SoftBank is one of our investors. Unlike WeWork, where I believe SoftBank was the only investor for multiple rounds, in all of our rounds we had multiple investors like Wellington, investors like Fidelity, like Dragoneer, and many others. And there are over, I believe, around 100 investments that SoftBank has made, and I don't think just one being the story of what you've heard from WeWork really has an impact on the others. They're all different businesses, different industries.
So when you say governance, as the CEO and founder, what is good governance and what was bad governance that led to some of the problems you saw there?
Absolutely. Look, I've been thinking a lot about the things to do and not to do. I was considering buying a $60 million plane.
This shot that down.
Yeah. With the company money, I was like, I can't do that anymore.
Right. How about the yacht? Did you buy the yacht instead?
I bought the yacht instead.
Yes.
That's funny. No, look, I think there's governance, but then there's really just, do you have a culture of frugality? Culture of investing for the future as opposed to, and really for your customers and for your investors. And that's really the culture of Compass.
Is Compass profitable?
And so at Compass, fortunately, the business of serving agents has been profitable for over 100 years. And so we're profitable in many of our markets, and we can be profitable across all markets within a 12-month period. It's just a function of how fast do you want to grow.
Okay. Sorry, so that sounds a little bit more like an Amazon-ish model as opposed to some of the other companies like an Uber or Lyft where they really couldn't articulate to investors a path to profitability.
Yeah, no, this definitely is an industry with a lot of profits to be had. I'm wondering, from your perspective, we're at a conference about sooner than you think, technological advancement. What are some of the technological advancements that you're looking within the real estate business?
Yeah, so we recently hired a 20-person AI team. And our new CTO came on about 10 months ago. He was CTO of AI at Microsoft, and before that, CTO of consumer at Amazon. And so AI has transformed many industries, and it will transform real estate as well. Some of the examples of what it can do is we have similar listings that are based off of everything that you're searching that's constantly recommending to you things that are similar to what you've searched. AI can look at every photo. We're in an image-based business, and when it's not clear enough, it can predict the pixels and make it clear, which is really important for a business like ours. And so AI is just one segment in itself. Overall, the biggest innovation at Compass is integration. The average agent logs into 13 companies every day to do their job. That's not a platform. Those are 13 companies. We're rebuilding from scratch all the different things that an agent needs to run their business and then putting it into one place.
So give us a sense from a technology perspective, who are your competitors out there? I know you compete every day with the local real estate agents in every market that you're in, but are there other people kind of doing similar things to what you're trying to do?
Yeah, so that's a great question. I'm fascinated that 7 years into Compass, that there's not another company that's trying to do what we're doing. and I believe, which is help agents be more successful by investing a lot of resources, money, and people into technology that build for them. I think my mom's an agent, has been my entire life. She's an agent at Compass. And
I would hope so.
Yeah. And she's 74 years old, having one of the best careers in her life. I think agents are the largest group of small business owners in the country, 2 million strong. The largest industry dominated by women. The only industry where there's hundreds of thousands of women that make 6 figures a year. One of the few industries where you get pushed to get better in your 60s and 70s, like my mom, don't get pushed out the door. And of the 87,000 brokerage firms in the country, the average amount of software engineers they employ is 0.
All right. You literally have 5 seconds. Are you going public? 5 seconds.
Yeah, we are likely going to go public in our future, but we do not have a timeline.
Robert Reffkin, fantastic. Compass founder and chief executive officer. We are slapping hands. Thank you so much for being here at the Bloomberg Senior Thing You Pick conference in Brooklyn.
This is the Bloomberg Market Minute. U.S. stocks are mixed ahead of the Fed rate decision. It's widely expected that rates will be lowered for the third time this year. The Dow is up 27 points. S&P 500 is flat. The Nasdaq is down 11 points. But shares of General Electric soared the most in 8 months today. The manufacturer raised its cash flow forecast for the second straight quarter. A reading on GDP came out stronger than expected at 1.9%, largely the result of increased consumer spending. President Trump's trade war with China is hitting key supporters financially. The American Farm Bureau Federation reports farm bankruptcies rose 24% in September. That's the highest since 2011. And payroll processor ADP finds U.S. businesses added just 125,000 jobs in October. Donna Wilson, Bloomberg Radio.
Welcome back to the Dog Show. Up next, we have Satchmo. Satchmo is a member of the Shelter Pet Group.
That's right, a group known especially for their couch-snuggling, ball-chasing, face-licking, and, of course, companionship. Now, let's see him in action.
Look how he makes eye contact with his person.
That's actually known as the treat stare.
How intuitive. And now he appears to be excitedly turning in circles.
The happy dance so common with this group.
But really, the best way to know an amazing shelter pet like Satchmo is to meet one.
Visit theshelterpetproject.org today. Adopt.
Brought to you by Maddie's Fund, the Humane Society of the United States, and the Ad Council.
In-depth analysis, concise reporting, need-to-know global business news. Around the world and across the markets, Bloomberg connects the dots for decision makers. Stay on top of today's headlines. Follow big breakthroughs in tech. Understand the latest political issues. See how the world's wealthiest are spending their money. Track what's happening in the markets, and much more. Subscribe today to Bloomberg, the global standard for business reporting. Get it all at Bloomberg.com/subscription.
It's another Wednesday afternoon, yet another windy day. So ditch the British winter and chase the sun across the globe with British Airways from London Gatwick and explore tropical rainforests. Fly from London Gatwick to Costa Rica with British Airways from £218 each way based on a return fare. Don't miss out. Book by November the 12th at ba.com/wintersun with British Airways. Incredible is within reach. Booking fees and conditions may apply. Limited availability. Selected flights in March.
Hey, it's me again, the TV. Since my family gave me Now TV, there's no more endlessly searching for something they want to watch, because now I don't do filler TV, just killer TV. If my family want crime dramas, I've got loads, and they're never going to guess who did it. Movies, I've got blockbusters. Or how about horrors? No problem. It's not real, it's not real, it's not real. Now they can watch whatever they're in the mood for.
What's your TV got for you tonight? Now TV. 18 plus, month passes auto-renew, terms apply.
Now the 3-1. And Springer hits it in the air, deep to left field, and you can kiss it goodbye.
MLB fans, you can hear every call of the 2019 World Series on TuneIn Premium.
That ball's hit well. Left field, high and deep. That's got a chance. Score!
The action concludes today with a winner-take-all Game 7. Will the Houston Astros or Washington Nationals be crowned as World Series champion? Listen live at 8 Eastern to find out. The 2019 World Series is on TuneIn Premium. Hey NFL fans, can't watch the game? Can't be there? No biggie. With your TuneIn Premium membership, you have unlimited access to every team and every game in the league. Listen live as it happens or on demand. Anytime, anywhere. All season long. Search NFL today.
In the stock market and in life, everything can change from 1 minute to the next. Be the first to hear the latest money news and market trends with CNBC on TuneIn. Wherever your day takes you, listen to CNBC's full slate of programming, including shows like Fast Money, Squawk Box, and Mad Money with Jim Cramer. And when the next big business story breaks, CNBC lets you know with live updates and commentary. At the office, at home, or on the go. Search CNBC on TuneIn to listen. In the dictionary, a podcast is this: a digital audio file made available on the internet, typically as a series, of which new installments can be received by subscribers automatically. But on TuneIn, a podcast is this.
I'm Rachel Martin with David Green, and this is Up First from NPR News.
And it's defined like this.
Ladies and gentlemen, welcome to the show.
From news, sports, to pop culture, comedy, and beyond. Define your own podcast possibilities on TuneIn.
ESPN Radio and TuneIn just go hand in hand. Hi, this is Mel Kiper Jr. reminding you that all of your favorite ESPN Radio shows and events are right here on TuneIn. Just search ESPN Radio to begin enjoying it today.
Like what you're listening to? Want to make getting back to it easier? Use the favorite button to keep track of the stations and podcasts you love on TuneIn. Just tap or click the heart icon to add it to your favorites. Then find all your go-to audio under the Favorites tab. Pretty easy, right?
broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C., Bloomberg 99.1 to Boston, Bloomberg 106.1 to San Francisco, Bloomberg 960 to the country, Sirius XM Channel 119, and around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Markets.
The Federal Reserve's decision is sooner than you think. Get that? We're at the Sooner Than You Think conference in Brooklyn. I know, I'm just explaining it if anyone's just joining us. Coming up, we're going to be speaking with Kara Kadana, Chief U.S. Economist for Bloomberg Economics. Plus, we're going to be speaking with Jason Ilian. He is Koch Disruptive Technologies Managing Director. This is the mid to late stage venture arm of Koch Industries. Let's get over to Charlie Pellet for a Bloomberg Business Flash. Charlie.
Thank you very much. We've got 28 minutes to go. The Fed decision live, 2 p.m. Wall Street time, along with Fed Chair Jay Powell's news conference, 2:30 p.m. Wall Street time. Stocks little change right now amid a mixed batch of earnings and data showing the U.S. economy has avoided a pervasive slowdown. Treasuries rose, the dollar flat ahead of the Fed's rate decision. Matt Hornback is global head of interest rate strategy at Morgan Stanley. He was interviewed this morning on Bloomberg Television.
Well, if they didn't cut interest rates today, you would see a dramatic flattening of the yield curve. We would certainly have reinversion on the 3-month bill versus the 10-year yield, which is a popular measure. So I think there's probably a 5% chance they don't cut rates.
Johnson & Johnson shares lifting the Dow Jones Industrial Average. The Dow up by 9 points now, up by less than 0.1%. We've got Johnson & Johnson up 2.5%. S&P down 2 points, lower by 0.1%. NASDAQ down 11, a drop there also of 0.1%. Yum Brands, C.H. Robinson, and Molson Coors slumping after reporting results. General Electric jumping after raising its forecast, while Mattel soared after a sales beat. Mattel shares, they're rallying now by 8.4%. GE up by 9.4%. Payroll provider ADP says businesses added 125,000 workers in October, topping the prior month's gain. Services led the increase. Small business hiring moderated. 10-year down up 11.30 seconds, 1.79%. Gold up 0.5%, $14.94 the ounce. West Texas Intermediate crude trading lower now by $1.66 a barrel. Down 1.6%, down 92 cents a barrel at 54.64. Again, recapping equities mixed. The Dow now little changed. S&P down 2 points, down 0.1%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Charlie Pellet, thank you so much. It is Fed Wednesday, just minutes away from the Fed decision. Help us get a little preview of what's to come. We welcome Carl Riccadonna. He's the Chief U.S. Economist for Bloomberg Intelligence. Carl, thanks so much for joining us. What are your thoughts here today as we kind of go into this 2 o'clock debate? Is it really going to be about kind of the body language from Chairman Powell?
Well, it's going to be about the forward-looking guidance from the Fed. It's pretty broadly anticipated that the Fed will cut rates at 2 o'clock by 25 basis points. Now, it's not unanimous among forecasters. About 1/5 of those who submitted forecasts to Bloomberg expect no change in rates, but still, that's a pretty strong consensus towards a rate cut. And if we look at Fed funds futures, it's even more firmly priced in. Now, the Fed had the opportunity to push back against expectations of a rate cut, and every time hawks and doves alike passed on that opportunity. So I really think that we have a high probability towards a rate cut. However, as we look towards future cuts, there is much less certainty, and I don't know that the Fed really wants to clarify that too much today. Instead, they want to maintain some optionality to cut further if economic conditions warrant.
Maintain optionality. In other words, this is going to be a snoozer, yeah?
Not necessarily a snoozer. There's a real debate over whether 3 cuts is enough, 75 basis points of easing. It certainly was enough in 1995.
Yeah, but they're not going to answer that.
It was enough in 1998, and so it would be a clumsy mistake if the Powell Fed came out and said, basically, we're done easing because the trade war is less hot, Brexit has been delayed, and GDP was stronger than expected. If they say 3 is a charm, then you're going to have, I think, a negative market reaction to that.
So, Carl, what did you make of the GDP news this morning, and how do you think that just kind of, makes its way into the mosaic at the Fed?
Well, the GDP data confirmed what we have been calling for since the middle of the year, which is, let's say, a consumer's gain in the back half of the year. If we look at the GDP contribution excluding consumption, it was essentially zero. So that tells you that really consumers are the only game in town driving the economy. And so as we want to understand what growth will look like in the next quarter or a couple of quarters, we really have to focus on things like consumer confidence, retail sales, those types of metrics. They held up just fine in Q3, but there are some question marks as to whether they can continue to have that kind of momentum in an environment where the pace of job creation is decelerating pretty appreciably.
So, Carl Riccadonna, this is going to be the moment of truth for you. Are you ready?
I'm ready.
Are you sure?
Yes.
Right. Do you have any traditions on Fed days where you wake up and have eggs for breakfast, or you have something special, or is there anything you do?
The only tradition is I get up really early.
Yeah, you get up really, really early.
So we can talk to people like us.
Exactly.
So I guess that looking at some of the data, because we got a bunch of economic data today, I'm trying to think what data the Fed is focusing on here, because for a while it was inflation metrics, and it's insert your big shruggy emoji here.
Sure. So the initial reason to start the easing cycle or the maintenance correction, whatever you want to call it, was the inflation soft patch we saw in the first half of the year, and very rapidly deteriorating economic conditions, partly due to the trade war, but not entirely, really usurped the Fed's motivations, as we saw rounds of tariffs, business investment basically stalling out and actually falling into contraction, the export sector sinking into contraction as well. So it's shifted from too low inflation, which still is very much present. Inflation is below target. Inflation expectations are at the low end of the range. So they're not making much progress in that front. But now the Fed is really looking towards leading indicators of economic activity. And just as I highlighted, consumers are the dominant driver. That means the Fed is very much attuned to all those leading indications of what consumer demand will look like the next couple of quarters. I believe it was Robert Kaplan, who said, we're focused on consumers, but the problem is, looking at history, that once consumers falter, it's often too late at that point. And so that's really the risk here, to really be watching for any canary in the coal mine that consumers might be faltering. If consumers falter, so goes the economy.
So, Carl, in your forecasting horizon, does Bloomberg Economics have a recession there at any point in time?
We don't. We view the risk of recession as being relatively low. So if we look at recession risk between now and the end of next year, our subjective assessment is about 15% probability. Now, I know a lot of model-based estimates are considerably higher than that. We also have a model-based estimate, and it's running in the vicinity of 25%. But this is just man versus the machine. Most recession... Are you the man?
I'm the machine.
I'm glad that you even asked that question, Paul. I'm flattered that you asked that. It feels like a machine on Fed Day.
We're trying to get as personal as we possibly can.
But the issue here is the machine doesn't have the element of human discretion, and so something that's in almost everyone's recession model is some version of the yield curve, whether it's 2s, 10s, 3 months, 10s, or other versions of the yield curve. And so the yield curve is very flat. It had been inverted quite recently, and so that tends to inflate the recession probability in these models.
Carl Riccadonna, thank you so much for being with us. Carl Riccadonna is Chief U.S. Economist at Bloomberg Economics, joining us on this Fed Day, Wednesday. You can catch it all right here. In 20 minutes, we will start our live coverage, where we'll parse through the statement.
Michael McKee is down in Washington, and he'll have some smart questions, I'm sure, for the Fed chairman.
Absolutely, some key questions as to how much, I'm not sure what he's going to ask, but how much the trade war and the trade tensions are really weighing into the calculus, along with Brexit, et cetera. I mean, there seems to be a shift from very much of a domestic focus to an international one. Yeah. And curiously, how do they gauge that at any given time when there is a lot of headlines coming out that are conflicting at any given time?
Yeah, as well. And we have the GDP data from this morning that also adds again to the kind of the data dependent Fed, and a data point that obviously they are focusing on. So some pretty strong GDP numbers For those of you who missed it, the came in a little bit better than expected, driven primarily, as we've become accustomed, by the consumer. Manufacturing and business investment continues to be a little bit weak.
Are you buying more than usual?
Oh, of course.
That's what happens when you have kids and a family.
Yes.
We're broadcasting for Sooner Than You Think in Brooklyn. This is Bloomberg Markets.
Hey, y'all. Jeff Foxworthy here. Now, if you've ever found yourself repeating the same thing over and over for 75 years, you might be Smokey Bear.
Only you can prevent wildfires.
That's why I'm filling in for Smokey to switch things up, because there's a lot more to say. And I should know because my grandfather was a firefighter. And one of the things he taught me is that the people that love the outdoors the most are often the ones accidentally starting wildfires, which means always BYOB. No, bring your own bucket to the campfire. And be extra careful with things like burning yard trimmings. Don't just walk away, or chances are you might be starting a wildfire. So for the love of the outdoors, go to SmokeyBear.com to learn more about wildfire prevention. Brought to you by the U.S. Forest Service, your state forester, and the Ad Council.
Why has J.D. Power ranked Commonwealth Financial Network #1 in independent advisor satisfaction among financial investment firms for the 6th straight time? We think it comes down to one thing: you. Because it's your input and feedback that keeps us focused on what's most important to you and your clients, and continually pushes us to be the best we can be. Maybe that's why we receive top marks in every category of the J.D. Power 2019 Advisor Satisfaction Survey. They named us #1 in client support, #1 in firm leadership, #1 in operational support, #1 in compensation, #1 in professional development support, and #1 in technology support. Ready to partner with the best? Call Commonwealth at 866-462-3638 or visit commonwealth.com and feel the power. Member FINRA SIPC, a registered investment advisor. For 2019 J.D. Power award information, visit jdpower.com/awards.
It's another Wednesday afternoon, yet another windy day. So ditch the British winter and chase the sun across the globe with British Airways from London Gatwick. Reach the top of Mount Teede or relax on a sandy beach. Fly from London Gatwick to Tenerife with British Airways, with flights and 7 nights hotel from just £349 per person. Don't miss out. Book by November the 12th at ba.com/wintersun with British Airways. Incredible is within reach. Booking fees and conditions may apply. Limited availability. Selected flights in March.
London, switch to Vodafone, the UK's best mobile network, and Be Unlimited, because the best phones deserve the best network and our new unlimited data plans. The future is exciting. Ready? Vodafone.
Max download speeds apply to unlimited data. Best network as voted by readers of trusted reviews. Terms at vodafone.co.uk/unlimited.
With the new Halifax Family Boost mortgage, children can get help to buy their first home, and mum and dad earn interest on their savings. Everyone's a winner. The new Halifax Family Boost mortgage. Halifax makes it happen.
Your home and savings could be at risk if mortgage repayments are not maintained. Only available in England and Wales. One applicant must hold a Halifax Reward or Ultimate Reward current account. Conditions and exclusions apply.
NFL fans, hear every live game on TuneIn Premium.
Toss to the right, throws to the end zone, caught by Fells!
15, 10, 5, touchdown Green Bay!
This Thursday on Halloween night, hear the home and away call as the San Francisco 49ers visit the Arizona Cardinals at 8:20 p.m. Eastern.
Back, what a block! Touchdown for Tevin Coleman going the other way! Touchdown!
At home or on the go, hear the home and away call of every NFL game this season on TuneIn Premium. Upgrade today.
Now the 3-1. And Springer hits it in the air, deep to left field, and you can kiss it goodbye.
MLB fans, you can hear every call of the 2019 World Series on TuneIn Premium.
And that ball's hit well. Left field, high and deep. That's got a chance. Score!
The action concludes today with a winner-take-all Game 7. Will the Houston Astros or Washington Nationals be crowned as World Series champion? Listen live at 8 Eastern to find out. The 2019 World Series is on TuneIn Premium.
Here's a swing and a drive deep to right field. Looking up. Goodbye, baseball.
Between game-winning shots and walk-off homers, follow TuneIn on social media to discover the latest and greatest in live sports.
With the 24th pick in the 2019 NFL Draft.
From live reminders that the biggest MLB games are on the air to recommendations of the best new sports talk shows and podcasts.
He's going to be fine. He's going to be good right away in 3 years.
Follow at TuneIn on Facebook, Twitter, and Instagram to get the most out of TuneIn.
In the dictionary, a podcast is this: a digital audio file made available on the internet, typically as a series, of which new installments can be received by subscribers automatically. But on TuneIn, a podcast is this.
I'm Adam Grant, and this is Work Life, my podcast with Ted. I study how to make work not suck.
And it's defined like this.
Blackout is a suspense-filled thriller from Endeavor Audio and Q-Code.
From news, sports, to pop culture, comedy, and beyond. Define your own podcast possibilities on TuneIn.
ESPN Radio and TuneIn just go hand in hand. Hi, this is Mel Kiper Jr. reminding you that all of your favorite ESPN Radio shows and events are right here on TuneIn. Just search ESPN Radio to begin enjoying it today.
Right now, instead of hearing this, you could be listening to the music that keeps you moving with TuneIn Premium. Find today's biggest songs and all of your favorites commercial-free. Visit TuneIn.com/premium to upgrade.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at TikTok on Twitter. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We've got 13 minutes to go ahead of the closing, ahead of the Fed decision. We have got the Fed, Jay Powell. We've got the chairman's press conference coming up at 2:30 Wall Street time. But again, 13 minutes to go ahead of the Fed decision. Complete coverage here on Bloomberg Radio. U.S. stocks a little changed amid a mixed batch of earnings. Also data showing the U.S. economy did avoid a pervasive slowdown. S&P now down 3 points, down 0.1%. The Dow swinging between gains and losses, down 2 points right now. NASDAQ lower by 12, a drop there of 0.2%. 10-year ahead of the Fed decision, up 10-30 seconds at yield 1.80%. Gold up 0.4%, $14.93 the ounce. And West Texas Intermediate crude down 1.8%, $54.55 a barrel. Recapping, U.S. stocks little changed. S&P down 3, down 0.1%. I'm Charlie Pellet. That's a Bloomberg Business Flash.
You're listening to Bloomberg Markets with Lisa Abramowitz and Paul Sweeney on Bloomberg Radio.
We are broadcasting live from the Sooner Than You Think conference in Brooklyn. Technologies disruption. Let's talk disruption. Jason Ilian, Koch Disruptive Technologies Managing Director. This is the mid to late stage venture arm of Koch Industries. Jason joins us here. Jason, thanks so much for joining us. Give us a sense of where, how you guys are deploying your capital. What's kind of your mandate as you think about some of the industries that Koch Industries is in?
Yeah, well, so Koch Industries is very diverse, right? So we're talking 130,000 employees in 60 countries. So we cover a lot of ground, which is awesome because you cover a lot of ground. The downside is you cover a lot of ground. So you see a lot of stuff, yes. And you have to cover a lot of different industries, right? So on one side, we're looking at robotics, industrial AI, you look at real estate tech, you're looking at what's the next generation of payment solutions, right? So it's a little bit of everything. And so when people say, what do you focus on? The answer is we don't, right? We work with our internal experts to say, hey, what areas should we be disrupted or look at disrupting technologies, and what other areas should we continue to extend our platform? So some things is, hey, we want to disrupt ourselves, and other ones is, hey, what other technologies and platforms should we be looking at that may have nothing to do with what we do today, but invest in? So as an example, we invest in a company called Insight Tech. It does non-invasive focused ultrasound on the brain. So people that have Parkinson's or essential tremors, you lay in an MRI machine with a special helmet, and they use ultrasound waves to ablate or burn the part of the brain that has the shakes. So if somebody lays in it for 2 hours, stands up, and the shakes are gone. Wow. So the first time I saw it, I was like, that looks like magic. Now, what does Koch have to do with MedTech? Answer, almost nothing. But it improves people's lives. So it aligns with our overall mandate. How do we improve people's lives by using fewer resources and you know, hopefully from their perspective, giving them more opportunity? And that one with great principled entrepreneurs fits that mold, so we invest in.
It's to change lives, but it's also to make money, I assume.
Oh, of course.
I mean, that has to be part of it. So
Absolutely.
how do you determine not only whether an idea is disruptive and truly innovative versus an executive team that actually can push it forward?
Yeah, it's a great question. So I think that comes down to, like, what are your filters? What are you looking for in a company, right?
That's a simpler way to ask it. That's probably more direct.
Well, and
better.
it's a great question in terms of, like, what's happening at WeWork and other things, right?
100%. Yes, I might have been thinking of it.
So the first one's exactly what you said. Are they principled entrepreneurs? So Coke was built on the idea of entrepreneurship. That's what built it from, the 1940s and 50s of working with other great people that align values. Most other places, I shouldn't say most, a lot of places will hire on talent first. We often look for values first. So what are these people's values and what do they believe in? So can we align with that leadership team? And then we say, hey, is their platform truly disruptive? What are the market alternatives? Are they disrupting those alternatives? Are they going to be better? And is it transformative, meaning it's not a small step change or a small incremental change. It's a massive step change to this new platform they're building. And if all that works, then the last step we say is, what's the mutual benefit? What can we help them with besides the capital? And what can they help us learn? And so almost every company that we've looked at, besides investing a sizable amount of capital, we've also have 5 or 10 strategic things we're doing to help that company. And likewise, they're teaching us about areas we're not experts in. So there is that mutual benefit.
Give us an example of kind of one of the more recent investments you've made and why you made it.
Yeah. So there's a company out of the Bay Area called D2IQ. And so simply everybody's talking about this lift and shift to the cloud, right? So how do you work with these big cloud providers, or how do you do AI and machine learning? Well, that sounds all great and sexy if you can get access to all your data and you can figure out how to have a modern architecture. So what D2IQ does is they use the Kubernetes stacks and more modern architecture to say, how do we quickly test and deploy something that's either in the cloud, on the edge, or in IoT, and use one pane of glass to monitor all this. That's huge for a company like ours that has hundreds of locations, right, and thousands of warehouses. Is how are we going to scale something across all that and use some type of modern architecture and software to do that? Well, D2IQ came in, and they're helping us on how we work with AWS and Azure and Google Cloud. And it's just something that people say it's not sexy like the AI, but you can't run AI until you know where your data is coming from and is it clean, and they help us do all of that.
So when I think of Coke, I think of the fact that it makes everything, that it has, basically everything from gasoline to asphalt to fracking chemicals to you name it.
Right.
I'm wondering, there also is a very strong political association with the Koch brothers, and I'm wondering how that affects your day-to-day when you're talking with some of these disruptors, whether they want to work with you.
It's really interesting that you bring that up. So I'm new to Coke in the last 2 years. And that was the first question that I asked, too.
Really?
And what I found out is that Coke has not done a great job of actually telling their story on what they stand for. And I don't think they're as closely aligned with the red or blue as you think, as most people think. And what it really comes down to is if you look at kind of how they operate as a company, it's more about their principles and how do they operate as their principles. And even Chase Coke, who's the president of our division, right, has his name on the building. We've had multiple conversations about this, and really what we found with these entrepreneurs is they just want to know that somebody has a value set that they operate by, and it's not just monetary, which happens in VC world, right?
So I guess the other concern would be one getting money from a big conglomerate, that big conglomerate would steal their ideas and run with them.
That's a question you have to overcome with any corporation, right? And
yeah, absolutely, whether it's Google, whether it's anyone.
Yeah. And so we have those conversations up front with every one of our entrepreneurs, right? And we sign NDAs when you have to sign them. We work closely with them. At the end of the day, if we want to work with somebody, it's because we can't do that, right? Like, we want to work with other great entrepreneurs, and that's how Coke was built. It was not about stealing ideas. The idea was, how do we work with them? How do we create that mutual benefit where we can help that company grow? And maybe we own a piece of it, but there's a lot of companies we introduced to the Coke ecosystem we have not actually invested in, but these are great individuals, great leadership teams, and we want to learn from them as well as help them deploy their technology across our companies. So we haven't run across any of that where somebody's concerned about stealing the idea. It's more about, hey, how can we truly partner? And most conglomerates aren't good at that. And what I say is, like, We just want to suck less, right? Everybody sucks. How do we suck less at doing this? And we're hopefully every day getting better and better at that.
It's sucking less.
It's sucking less. It's a high bar.
I wake up every morning
exactly.
and I'm like, how can I just suck less today?
Don't tell my boss I say, all I'm trying to do is suck less. Don't put him on the radio again. I told you not to do that.
Jason Elaine, thanks so much. Coke Disruptive Technologies MD joining us here at the Bloomberg Conference. Let's chat with our good friend Carol Massar. We have Bloomberg Business Week coming up on Bloomberg Radio.
Mouthers.
I know, exactly, Carol.
Wow.
How are you? What do you got going?
A little thing called the Fed meeting. We're expected to see the Fed cut for a third straight meeting. So, of course, we'll have that decision, Paul and Lisa, and then, of course, head to Washington, hear from Jay Powell. We want to hear what he has to say at the press conference, and whether is it 3 and done for the year? I don't know. We'll find out. So, no potty mouths here. I'm just going to say that.
Absolutely. Carol Massar, thank you so much. That's Bloomberg Business Week coming up in just moments. Lisa Abramowitz, we are here at the Bloomberg Sooner Than Anything Conference in
Brooklyn. We're in Brooklyn. This is your annual trip to Brooklyn.
We are right across the street from Peter Luger's restaurant.
We are. I will say this is such a cool building
too.
It's awesome. It's this renovated old bank. They've got the whole vault door downstairs. But most importantly, some of the provocative discussions that I will continue to think about on the frontiers of technology and the ethics that have emerged. This is Bloomberg.
It's another Wednesday afternoon, yet another windy day. So ditch the British winter and chase the sun across the globe with British Airways from London Gatwick to enjoy a warm Bayesian welcome.
How are you doing? Enjoying the sunshine?
Fly from London Gatwick to Barbados with British Airways, with flights and 7 nights hotel from just £699 per person. Don't miss out. Book by November the 12th at ba.com/wintersun. With British Airways, incredible is within reach. Booking fees and conditions may apply. Limited availability. Selected flights in March.
London, switch to Vodafone, the UK's best mobile network, and V Unlimited, because the best phones deserve the best network and our new unlimited data plans. The future is exciting. Ready? Vodafone.
Max download speeds apply to unlimited data. Best network as voted by readers of trusted reviews. Terms at vodafone.co.uk/unlimited.
Hello? This is Dustin. I found something. Is anybody there?
We hear you, Dustin. With Sky Q, you can easily catch up on epic Netflix shows like Stranger Things and then watch award-winning Sky originals like Chernobyl. Get Sky and Netflix all in one place on Sky Q for one surprisingly low price. Just £25 a month. Visit sky.com and join today. Offer ends November 14th. 18-month minimum terms. Prices may change during contract. Requires Sky Q box connected to broadband. Set up from £20. Further terms apply.
Watford, there's nothing like coming back to a warm home after a long day at work. Especially when you've been stuck at a cold train station in rush hour for what seems like an eternity. Luckily, with Hive Active Heating, rated 5-star on Trustpilot, you can turn your heating on from wherever you are. And now with our new Hive radiator valves, you can even control your heating room by room. Search Hive Heating to buy now. Hive services require broadband and Wi-Fi. Terms apply.
Now the 3-1. And Springer hits it in the air, deep to left field, and you can kiss it goodbye.
MLB fans, you can hear every call of the 2019 World Series on TuneIn Premium.
And that ball's hit well. Left field, high and deep. That's got a chance. Score!
The action concludes today with a winner-take-all Game 7. Will the Houston Astros or Washington Nationals be crowned as World Series champion? Listen live at 8 Eastern to find out. The 2019 World Series is on TuneIn Premium.
Financial capital of the world, 24 hours a day at Bloomberg.com, on the Bloomberg Business app, and at TikTok on Twitter. This is Bloomberg Radio. Bloomberg Business Week, the Fed in focus.
They've really been steadfast about providing the stability that this country needs.
It's not what they do, it's what they say afterwards.
I wouldn't put it past the Fed to do a very quick 180 here.
It's all about the year ahead at the Fed at this point.
The Fed in focus on Bloomberg Radio.
And a very good afternoon, everyone, live from the Bloomberg Interactive Broker Studio. Welcome to Bloomberg Business Week on this Fed Decision Day, and the Fed crossing the headlines. Uncertainties remain. We'll assess appropriate rate path, cutting the federal funds rate target 25 basis points to 1.5 to 1.75%. So as expected, Jason, cutting for a third straight meeting. We're going to dig into some of these headlines.
Omitting acts as appropriate. I want to understand what that means when we get to our experts in just a minute. But first, let's get some market reaction from Charlie Pellet. Hey, Charlie.
Right now, we have got the S&P 500 index down 6, down 0.2%. Stocks flat. Heading into that announcement, the 10-year up 7/30 seconds with a yield now of 1.81%. The Dow down 29 points, dropping 0.1%. NASDAQ lower by 25, down 0.3%. Gold up 0.2, $14.89 the ounce, and West Texas Intermediate crude down 1.5%, $54.71. So again, a drop for the Dow, down 35, down 0.1. S&P now lower by 8, down 0.3. NASDAQ down by 0.3%. I'm Charlie Pellet. That's a Bloomberg Business Flash.
Charlie, thank you so much. You're listening to Bloomberg Business Week, the focus on the Fed, brought to you by Commonwealth Financial Network for the 6th straight time. J.D. Power ranks Commonwealth #1 in independent advisor satisfaction among financial investment firms. Visit commonwealth.com to learn more. We are all about the Fed right now.
So most read story, just want to get to our Chris Condon, who puts out our Fed story. Federal Reserve officials reducing interest rates by 0.25 percentage point for the third time this year, hinting they may now put monetary policy on hold for one meeting at least. And we did see equities dig a little bit deeper into the loss column as a result. And as for yield, a slight uptick, but really slight. Let's get into this with our team. Kathleen Hayes is Global Economics and Policy Editor here at Bloomberg News. She's in our Interactive Brokers studio in New York, along with Dave Wilson, our stocks editor at Bloomberg News. Kathleen, right to you, what stands out? Does this mean the Fed is on pause for December?
No.
Okay.
I don't think so. I do think, though, they could be. I think that the fact that Jay Powell and the Fed, the FOMC, took out act as appropriate to sustain the expansion, which had become a phrase that everyone took to mean we're going to keep cutting interest rates. That's gone, but they're going to monitor the data and assess the appropriate path of the target range for the federal funds rate. So to me, it's pretty clear. I think this is more or less what people expected. You want to get away from promising to do a rate cut at every meeting and maybe even December, but if the data are weak enough, right?
Yeah.
Then there's the door is still wide open. And again, I think now we have, go ahead. Quickly.
Well, this is what I don't always get, because it's like, I understand that they take a phrase out of the statement and we, assess the significance of it. But the Fed's going to act appropriate as needed no matter what, whether it's in there or not, right?
But
so what's the
significance is that when this statement that they make, the policy statement, is understood to be, which it is, something that is so carefully worded. Remember when the forward guidance under Bernanke and then Yellen was, keeping rates low for an extended period? That was considered really important. When they removed that, it was a big deal.
Right.
So removing this is one of those subtle but so clear signals that they have made a shift. I just think it's so important, though. It doesn't mean they won't cut in December. It just means that, this division we've seen, those who don't think we need to cut at all, those who think we need to cut more, those in the middle are trying to figure out what we need to do, or say, hey, we just cut rates 3 times. And let's don't forget, everybody, in the background, we do see a mini trade deal forming. Maybe the trade part is moving ahead. And if there's been one big weight on the U.S. economy, on the global economy, it has been the tensions from trade, manufacturing slowing, et cetera.
Although wasn't APEC, did we talk about this? Wasn't it canceled?
Yeah, it was.
Isn't that where they're supposed to meet?
Well, maybe they'll find another place to meet. I was thinking maybe Mar-a-Lago.
It's sort of like that moment where you say, oh, that place we used to go is closed. Do we need to find a new place? President Trump, President Xi. They'll write each other beautiful letters. Dave Wilson, come on in here. The stock market reaction, the equity side reaction, sort of bounced a little bit downward, if I could say that. Right. And now it's sort of bouncing back up more or less to where it was. How does an equity investor read this?
Well, in short, not much of a reaction as far as the immediate move goes. Beyond that, if you look at what's been going on in stocks lately, you see there's been a real preference for bond proxies. Now, what we're talking about there, utilities, real estate companies, they've actually been the best performers in the past 3 months among the 11 main industry groups in the S&P 500. So, in fact, today, utilities are the best performers, and they barely budged after this rate decision. So it's clear that what people were figuring on going into the meeting is playing out in terms of the decision, and it's being reflected in the shares. I mean, heck, I was reading a report today from Bank of America talking about that's, where the money's flowing, into the bond proxies and not into bonds. So it's like there's nothing that really kind of changes the equation at this point in terms of investor preferences.
Right, utilities, healthcare, consumer staples. That's, if I look at the SPX, the S&P 500, and the Bloomberg IMAP function on the terminal, that's where you see a little bit of upside in today's trade.
A little bit. I mean, and real estate stocks are holding up reasonably well. Their index is only down 0.1% at the moment.
Well, let's remember that two things that happened today. One, I mean, you guys are talking about stocks and where they've been, but think about it. S&P 500 is hitting another record, another record, right? And today, GDP came in at 1.9%, a bit stronger than forecast, so just above what the Fed sees as potential. We're waiting for a jobs report on Friday that could be on the weaker side. But I mean, I think if you're one of the people at the Fed saying, let's stop now, you're feeling pretty good about that decision, right? Those kinds of things are backing up your sense that, the world's been tough. The trade war maybe we'll go backpedaling all of a sudden. But for now, it doesn't seem to be that the reason it's not as compelling to keep going and cutting rates. But I think the stock market rally's got to be a big one.
Right.
Yeah, it's a good point.
And so we will hear from Fed Chair Jay Powell in about 25 minutes or so. He'll take the podium in Washington. Kathleen Hayes, what do you expect will be the key questions that he will get off the top?
Is this a pause, or are you telling us no more interest rate cuts? Why? If he says, dances, whatever he says, they're going to say,
dance, though, isn't he?
Well, I think he's going
to do that little data-dependent dance that he does.
I think he's going to say,
called the Fed Shuffle, I believe.
I think I'll be very interested. I don't know, because Jay Powell, in a lot of ways, is a pretty straight shooter. He may say, well, we mean what we said. Yeah, things are looking a bit better. We've cut rate 3 times. So, yeah, this may be a pause, but we are watching. It also says that we're going to follow the appropriate path for the federal funds rate. And then people are going to say, well, what are you watching? Are you watching the jobs report? What if it's weak? Well, are you watching the stock market? Well, is it the trade war? And he's going to be hit with so many different questions on this. I think we should get some good perspective. I think we'll get more information, and Jay Powell knows full well that this is what the press conference is for. It's to flesh out that policy statement, and as much as he can, clarify the FOMC thinking.
Well, and when we have the Fed say, once again, which we've heard them often say, uncertainties remain, I want to know specifically, I'd love a pecking order of, so what's the biggest uncertainty?
There you go. Absolutely.
Because then you can assess it, and then maybe figure out and predict what future Fed policy is.
Absolutely.
Maybe you should ask Jay Powell a question.
Well, if I was in Washington, I would.
Let's just do the show right in that.
You think he's on Twitter?
Right
I'm thinking
newsroom.
not.
Yeah. And then we'll say, Jay, can you keep it down? We got to do it quick.
Order, Mr. Powell. I have a question. Sorry.
And so, Dave, are there certain sectors that you look at as you go down a level that react in one way or another to this type of decision?
Well, I mean, just looking at today's trading, and you're not really seeing a whole lot post-Fed that you didn't see pre-Fed.
Right.
So it's not like there's really that much movement within the industry groups. I mean, like I say, seeing utilities on top of the heap, though, is kind of telling, and they're hanging in there. I mean, so it shows that, people looking for income, focusing on the stock market as much or more than they do on the bond market.
This is where I like to reconcile maybe what we're going to hear from the Fed if, they're being a little bit more optimistic. So we've got to see what they're looking at. But I do wonder what the equity markets, as Kathleen said, here we are continuing to hit records out there. There's a fair amount of recession talks. We've heard it from the CEOs, concerns about trade in their earnings releases. So I'm trying to reconcile what the equity markets are telling versus some of the economic data points and what we might hear from Jay Powell. What does the equity market tell us? What do earnings tell us, Jay?
Well, clearly people are expecting better results down the road. And that's consistent with the analyst forecasts, anticipating a return, to growth in the fourth quarter, assuming they end up being right for the third quarter and S&P 500 profit falls. And then next year, you get back toward 10% growth if you buy what the analysts are selling in terms of their predictions. That said, I have seen lately, some strategists kind of expressing optimism about next year when it comes to earnings and saying that at least there are some investors kind of going along with that view.
Quickly, I just want to add that, Jim Bullard has been dissenting for bigger cuts, for more, and today he didn't dissent. So I think that's very interesting. Jim Billard, St. Louis Fed president, if he is now ready to say, okay, we cut 3 times, I wanted to try, and the yield curve has uninverted, right? I've helped change that. Inflation expectations are still low. Inflation is still below target, but we've done enough for now. Sit and wait. I think that is a pretty significant voice to join that consensus in the middle, saying we've done enough for now. Let's see what happens next.
Yeah. All right. Well, I think we're going to leave it there with you guys. We really appreciate it. Kathleen Hayes, Global Economics and Policy Editor for Bloomberg, here in our Bloomberg Interactive Broker Studio, and Dave Wilson, Stocks Editor for Bloomberg. He's also here with us in New York City.
All right, time to head on over to Charlie Pellet for a check on the world of business and a look at today's trading day.
All right, thank you very much. We've got the Dow higher, S&P, NASDAQ both lower, recapping, resetting, Fed officials reducing rates by a 0.25 percentage point for the 3rd time this year, hinting they may now put monetary policy on hold for 1 meeting at least. Our coverage will continue in just a moment right here on Bloomberg Radio. S&P down 2 now at 3,034. That is a drop of 0.1%. We've got the Dow higher, little change now, but on the plus side, up 7, up by less than 0.1%. We did see a dip right after the headlines crossed on the Bloomberg, but again, the Dow rebounding. NASDAQ down 6 now, a drop there of 0.1%. Your 10-year up 11.30 seconds, yield 1.79%. Gold up 0.3, 14.91 the ounce. West Texas Intermediate crude a retreat today, down 1.2%, 54.87 a barrel. So again, Fed cuts rates by a 0.25 point while hinting at a pause. S&P down 2 points, lower by 0.1%. I'm Charlie Pellet. That's a Bloomberg Business Flash. Now a look at world and national news. Here is Bob Moon.
Charlie, thank you. The second highest ranking official at the State Department faced off with senators today who demanded to know why he didn't know more about the Trump administration's back-channel diplomacy with Ukraine and the dismissal of the former U.S. ambassador there. Issues now at the heart of the impeachment inquiry into the president. Deputy Secretary of State John Sullivan contended he didn't need to know Trump's reason for recalling Marie Yovanovitch, who reportedly objected to the administration's backdoor diplomacy.
When the president loses confidence in the ambassador, right or wrong, the ambassador needs to come home.
Sullivan is himself now President Trump's nominee to be ambassador to Russia. He told senators at his confirmation hearing that he wasn't aware of any attempt by the president or others to press Ukraine to investigate corruption supposedly engaged in by Democrats. A wind-driven wildfire burning northwest of Los Angeles has grown to 1,300 acres, with flames approaching the hilltop Ronald Reagan Presidential Library, where Executive Director John Hubush says no damage has occurred.
The fire started making their way here early enough this morning, about 5:36 a.m., and as a result, we were able to reach every employee of the library and all the volunteers to let them know this would not be a good day to come to work.
That fire is now threatening some 6,500 homes. The White House says it still wants to sign the first phase of a new China trade deal next month, even though the summit where it was to have happened has been canceled. President Trump was to travel to Santiago, Chile in November to sign the preliminary agreement with China's Xi Jinping. Global news 24 hours a day on air and at TikTok, on Twitter. I'm Bob Moon. Jason, Madam Speaker, back to you.
Lovely. Very well done, Mr. Moon.
All right, Bob, thank you so much. You are listening to Bloomberg Business Week right here on Bloomberg Radio.
When it's 3, you can see it's a magic number.
Well, and it seems like 3 was the magic number, at least for now. The Fed, as expected, cutting for a third straight meeting. Let's get into that decision and some of the analysis we heard from the Fed so far. Of course, in about 15 minutes, we will head to the Federal Reserve to hear from Fed Chair Jay Powell. In the meantime, Ari Jersey, he is our chief U.S. interest rate strategist here at Bloomberg Intelligence. He's with us, along with Steve Blitz, chief U.S. economist at T.S. Lombard, both in our Bloomberg Interactive Broker Studio in New York. Ira, I'm going to start with you. You've been taking part in our Bloomberg Live blog. What's notable to you in this Fed decision?
Yeah, not really a lot. There wasn't much that changed. I think that some people were expecting, including me, quite frankly, that they would have at least modestly changed their assessment of the economy. So they have this whole first paragraph where they talk about the economy, and they basically left it unchanged. And I think, with things like the Michigan survey of consumer attitudes, and in particular the inflation portion of that hitting all-time record lows, knows, that they would have at least acknowledged that inflation was still running below their target. So so some people, and I think the market reaction, the rates market, is suggesting that the Fed will have to do more because they're not yet acknowledging the fact that the economy is not as strong as they hoped it would be by this point.
All right, Steve, so come on in here. What was your initial read? You were sitting in our lovely Bloomberg Interactive Brokers Lounge, looking at all of this played through on the Bloomberg. You've got your notes. What jumped out at you?
Well, two things. First of all, I've been expecting the Fed to say we're done. Now, we know the Fed's never just going to come out and say we're done. But when you go from we'll monitor and act as appropriate to we'll monitor and assess the appropriate path, they're done. Now, obviously, what they're saying is if the data falls apart between now and December, they'll act again. I mean, they're always going to leave that door open. They're not going to close it completely. And in fact, if you look at even third quarter GDP, you look at so much economic data from their perspective, right? And you listen to Powell's speech from a couple weeks ago. They think the domestic economy is just fine.
So you don't think, like Ira said, that they're kind of ignoring some of the weakness in the economy? You don't agree?
I don't think so much that they're ignoring the weakness. The weakness is the reason why they've cut 3 times. The reason is why over the next 8 months, they're basically putting back all the tightening they put into the balance sheet, they're putting it back. They are buying over the next 8 months about 95% of net new treasury issuance. That's a lot of cash going into the bill market. It's going to steepen the curve. It's going to help weaken the dollar. These are all the things that they've wanted to get done.
Don't call it QE, though.
Well, it's not QE because they're not buying term yields.
Yeah.
But, if you take all the gold away and then you put it back, it's still policy. So,
what do you say to it?
Well, I think a couple of things. I think, firstly, that the Fed will probably actually slow down its bill purchases come January. So we're expecting closer. It's still a lot, right? So they're still buying a lot of bills, a lot of net issuance. But it's not QE just because of what they're buying. And in a way, it's kind of like balance sheet normalization because they haven't owned T-bills for 12 years, and now all of a sudden they're going to buy T-bills again, which they haven't owned for a very long time. I think on the other side that, I agree that the Fed's not ignoring it. I suspect that since we're doing this in real time, I expect that we'll see a bigger market reaction from the press conference than we did the statement, because I think that there'll be a little bit more nuance in there. I would be shocked if Jay Powell, particularly if they are done tightening or easing, and they don't want to cut in December at least, that he'll talk about monetary policy working on long and variable lags, and we're not sure what that is, and we need to see more incoming data before we make any additional decisions, right? So something along that vein, I think, will be reiterated 2, 3, 4 times during the course of the press conference. And the more you hear that, the more that means they're not going in December. Well, and it doesn't take January off the table by any stretch, but I think that January would be
it doesn't take any month off the table. But you have to recognize, they made, in terms of the communication, they made this move on the balance sheet a couple weeks ago when everybody was expecting them to announce it at this meeting, because they wanted to say something special at this meeting, and they didn't want to have the message mixed up with the balance sheet. There was no fire drill on October 11th that required them to make that particular announcement about what they wanted to do over the next 8 months.
I disagree with that, because in the funding markets, in the Treasury market, they were really worried about what was going to happen on October 15th during the settlement of a significant portion of new debt that was going to be issued. And the balance sheets of dealers has been very tight. So they wanted to do something to at least alleviate the idea that we're going to have tight funding markets forever. And they didn't want to have to do, massive open market operations in order to alleviate that stress on a moment's notice. So I think that that's one of the reasons why they announced it on October 11th as opposed to wait here. Now, I initially thought that they would probably wait till this meeting to do it, but at the same time, I think that they were really scared because they were getting
necessitated it.
Yeah, or at least the market fear. Yeah, so the market fear to get ahead of it. Let's announce this. So at least if they know that at least we're paying attention, if nothing else.
I love when you guys disagree.
Well, I would say this. First of all, they could have done repo, right? Secondly,
well, they are.
Well, I know that, but they could go back to the way life was before 2008 and just do repo. The truth is that because of regulatory reasons, basically, you have balance sheets at the broker-dealers and at the banks that are smaller than they've been since at least 30 years, if not longer, while obviously the debt side has grown. So they have to be the balance sheet. Now, to say it's not QE, okay, is falling into their semantic argument. Okay. The fact is that they are adding a tremendous amount of liquidity to the system. They need to buy bills because if they don't buy bills, they can't grow their balance sheet because they have to quash the yields at the lower end so that banks will hold these reserves, which are not required at the Fed. If it just keeps leaking elsewhere, they can't grow their balance sheet. So they have to quash yields at the lower end, which is why they're buying bills, right? So now, if I buy this many bills, 480 billion, over the next 8 months, that's a lot of money, and it's going to impact the market. It already has begun to do that, in terms of watching slow steepening of the curve. So if you're the Fed, you've got a steepening of the curve, you've got a lessening of foreign headwinds, at least seemingly, with the U.S., China, and the domestic economy, from their perspective, it's doing fine, and that they've done enough given leads and lags. And I agree. You're going to hear a lot about leads and lags in the press conference.
I just want to mention the equity markets are now in positive territory. So we've bounced back. The Dow's up 30. The Nasdaq's up about a point, little changed, unchanged almost, but a little bit higher. So a fraction on the S&P. I'm just saying the equity markets.
It's no idea to watch it sort of. I mean, it's bouncing really right along that gain and loss.
And the bond market's pretty much where it was.
So if you're the Fed, there's no recession. So there's a limit to how far you're going to cut rates because of your financial stability issues, et cetera. So they weren't, even the Trump wants it, they're not going to zero without a recession. So there's a normal point for them to stop. What they need to do is have the markets buy in that they're stopping, not for a bad reason, but for a good reason, that the economy looks like it's going to do better. And if the market buys into that viewpoint, the equity market does better, the curve steepens up a little bit, and it's back to being risk on. Right. And if the data follow through, they're not cutting again for, until the data tells them.
In fairness, the market had already been discounting a cut until May or June of next year, right? So basically, the statement, at least from a market perspective, seemed to be pretty much what the market was anticipating, right? I think a few people, obviously, given the market reaction, had expected them perhaps to be a little bit more dovish, but it's semantics and not that big of a deal.
So, Ira, let's go back to this press conference that we will hear in give or take 7-8 minutes when Jay Powell takes the podium down there in Washington at the Federal Reserve because, and everybody around this table knows this well, the stock market has generally, shall we say, not been a big fan of these press conferences in terms of it has, I think, in all but one meeting, there's been a sell-off as Jay Powell has been speaking. What is he going to be saying? What does he need to say to at least keep us kind of where we are here, which is just barely in the green?
Well, I'm not sure about
the equity market.
For the equity market, I suppose for all risk assets, they just want to make sure that they're nowhere near tightening and that they're going to keep on. There's other things that he can hint at too, right? So there are some dovish actions that he might be asked about. So, for example, the mortgage basis, the difference between mortgage-backed securities and treasuries is the widest that it's been since for about 3 years, right? And so one of the things that he could hint at is, if someone asks him this question, which I hope someone does, what other dovish actions can you take without actually cutting? He can say, well, we can start reinvestments of mortgage-backed securities again, which might tighten the basis, right? So that could be one of the things. We can buy longer-term securities and basically saying we could start QE. So there's other things that he could do besides cutting rates more.
So what do you want to hear, Steve Blitz, when Jay Powell speaks in 7 or 8 minutes?
Clarity of purpose. How's that?
Meaning what?
Meaning,
Carol asks that of me every day.
It's just like
another name for a garage band. Clarity of purpose.
I think what you need to hear is just some plain, simple talk about what they're doing and why, and rather and not stumble over his words and get the kind of negative market reaction he's gotten in the past. Look. 10-year yields are down, the housing market's responding, capital spending will respond with a lag and all of that. And he just needs to lay out a very positive economic story
But can he do that? I mean, Ari, do you think that there's enough there to
I think it's a little bit tricky, but when you look at some of the data that I look at, for example, ISM new orders, which tends to be a very good leading indicator of a lot of other things, that looks like it may have stabilized, which is not dissimilar to what happened in 2016. So unless you start to make kind of new lows in some of that kind of data, you can argue that we're starting to stabilize the economy. And assuming it stabilizes, then it means that the Fed's probably done its job, and then you have to wait, 2-3 more months at least before you get enough data to say that, hey, the Fed, needs to do more or not. And I think that's where we would like to get the market at this point. So kind of say, like, look, we're steady. Let's wait until early next year.
Right, which is exactly the point. What is it that says to you, Steve, that it's a strong economy or decent?
It's not so much. I think it's the point that things are bottoming out. I mean, if you look at a lot of the manufacturing data right now, in the very short term, it's a little mixed up because of GM.
Or it's just below 50 right now.
But it looks like it's stabilizing out. The household sector continues to buy. The great inventory reduction hasn't really occurred. Net exports are kind of soft, so you don't see anything that's really deteriorating, and housing is starting to pick up.
Don't we need companies, though, to do capital expenditures in order to keep this economic momentum going? Like, we're late in the cycle. Don't we need that?
Yeah, ultimately? We do ultimately, but that's going to take a while because that tends to follow profits by about 2 quarters. So we need to turn in profits, and everything that's going on should eventually turn profits, and that becomes more of a 2020 or a late 2020 story than something you're going to get over the next couple quarters, and they know that. I mean, they being the Fed in this case.
So, Ira, I want to ask you, this whole sort of repo market question. I mean, it's been so front of mind. I mean, we've talked about the repo market on this show probably more cumulatively over the past month than we had in the previous 10 years. How much do you think that will come up in the press conference? I mean, you've got Jamie Dimon talking about it. You've got the Secretary of the Treasury talking about it. And in what context? What can the Fed chairman say to sort of calm people down here?
Well, for one thing, I think he could point to evidence that right now it looks like this month end is going to be just boring in terms of funding markets. Right?
In a good way.
In a good way, yeah. So basically, they've basically provided enough liquidity to the funding markets via the repurchase agreements that they've been doing, both term and overnight, that the market's not going to be significantly worried about funding treasuries. And I think he could talk about. He is probably going to talk about, is there going to be a new facility that they're going to do that's going to maybe be a full allotment overnight facility instead of them doing the current operations, which are more traditional kind of repurchase agreements. I'm not sure they have to. They can keep on doing what they're doing, and that would work out fine. But I think he's going to be asked about that, and a lot of the details in that, quite frankly, won't come out at the press conference. Those will be things that will happen probably else in other forums.
Maybe some good reporting by Bloomberg News reporters will elucidate some of that. I have a feeling. All right, Ira Jersey.
Thanks, guys.
Thank you so much. Chief U.S. Interest Rate Strategist for Bloomberg Intelligence, and Steve Blitz, Chief U.S. Economist for T.S. Lombard, both here with us in New York City. Let's get to Charlie Pellet. He's got an update on the trade in the wake of the Fed decision. Hey, Charlie.
Thank you very much. We are awaiting Fed Chair Jay Powell, so let's recap, reset, and review as the Fed decides. Federal Reserve officials reducing rates by a 0.25 percentage point for the third time this year. They're also hinting they may be done loosening monetary policy, at least for one meeting. Steve Blitz is Chief U.S. Economist at T.S. Lombard. He was interviewed moments ago right here on Bloomberg Business Week.
I've been expecting the Fed to say we're done. Now, we know the Fed's never just going to come out and say, we're done. But when you go from we'll monitor and act as appropriate to we'll monitor and assess the appropriate path, they're done.
The 10-year up 11/30 seconds yield, now 1.79%. S&P down a point, little changed, 3,035. The Dow up 20, that's a gain of 0.1%. NASDAQ lower by 4, down 0.1%. Gold up 0.1%, $14.88 the ounce. West Texas Intermediate crude down 0.9%. Stocks recapping here. U.S. equities little changed with the S&P down a point. I'm Charlie Pellet. That's a Bloomberg Business Flash.
Charlie, thanks so much. You're listening to Bloomberg Business Week. It's Fed Day, so we've got an eye on what's going to come next in Washington, and that is Jay Powell himself, who will be headed out momentarily to the podium to give a brief statement, then say take some questions from our colleagues and others in the media.
Yeah, certainly we want some clarity on what this means by omitting from that statement, act as appropriate. What does it mean by taking that language out? You can assume that we're going to get a lot of questions on that specifically. And then when the Fed says, the FOMC specifically saying that there are uncertainties that remain, that's a big one. Let's head to Washington and Jay Powell.
Good afternoon and welcome. My colleagues at the Federal Reserve and I are dedicated to serving the American people. We do this by steadfastly pursuing the goals that Congress has given us: maximum employment and stable prices. We're committed to making the best decisions we can based on facts and objective analysis. Today, we decided to lower the interest rates for the third time this year. We took this step to help keep the U.S. economy strong in the face of global developments and to provide some insurance against ongoing risks. As I will explain shortly, the policy adjustments we've made since last year are providing, and will continue to provide, meaningful support to the economy. We believe that monetary policy is in a good place. The U.S. economy is in its 11th year of expansion, and the baseline outlook remains favorable. The overall economy is growing at a moderate rate. Household spending continues to be strong, supported by a healthy job market, rising incomes, and solid consumer confidence. In contrast, business investment and exports remain weak, and manufacturing output has declined over the past year. Sluggish growth abroad and trade developments have been weighing on those sectors. Looking ahead, we continue to expect the economy to expand at a moderate rate, reflecting solid household spending and supportive financial conditions. The job market remains strong. The unemployment rate has been near half-century lows for a year and a half. The pace of job gains has eased this year, but has remained solid. We had expected some slowing after last year's strong pace. Participation in the labor force by people in their prime working years has been increasing, and wages have been rising, particularly for lower-paying jobs. People who live and work in low- and middle-income communities tell us that many who have struggled to find work are now getting opportunities to add new and better chapters to their lives. This underscores for us the importance of sustaining the expansion so that the strong job market reaches more of those left behind. Inflation continues to run below our symmetric 2% objective. Over the 12 months through August, total PCE inflation was 1.4%, and core inflation was 1.8%. Inflation pressures remain muted, and indicators of longer-term inflation expectations are at the lower end of their historic ranges. We're mindful that continued below-target inflation could lead to an unwelcome downward slide in long-term inflation expectations. However, against the backdrop of a strong economy and supportive monetary policy, we expect inflation will rise to 2%. Overall, we continue to see sustained expansion of economic activity, a strong labor market, and inflation near our symmetric 2% objective as most likely. While this has been our outlook for quite some time, our views about the path of interest rates that will best achieve these outcomes have changed significantly over the past year. As I mentioned, weakness in global growth and trade developments have weighed on the economy and pose ongoing risks. These factors, in conjunction with muted inflation pressures, have led us to lower our assessment of the appropriate level of the federal funds rate over the past year. In both July and September, we reduced the target rate for the federal funds rate by 1/4 percentage point, and we did so again today, bringing the range to 1.5 to 1.75%. The policy adjustments we've made to date will continue to provide significant support for the economy. Since monetary policy operates with a lag, the full effects of these adjustments on economic growth, the job market, and inflation will be realized over time. We see the current stance of monetary policy as likely to remain appropriate, as long as incoming information about the economy remains broadly consistent with our outlook of moderate economic growth, a strong labor market, and inflation near our symmetric 2% objective. We believe monetary policy is in a good place to achieve these outcomes. Looking ahead, we'll be monitoring the effects of our policy actions along with other information bearing on the outlook. as we assess the appropriate path of the target range for the Fed funds rate. Of course, if developments emerge that cause a material reassessment of our outlook, we would respond accordingly. Policy is not on a preset course. Let me end with a few words about our technical monetary policy operations. In January, we made the key decision to continue to implement monetary policy in an ample reserves regime. In that operating framework, we control the federal funds rate primarily by setting our administered rates, not through frequent interventions to actively manage the supply of reserves. In the transition to the efficient and effective level of reserves in this regime, we slowed the gradual decline in our balance sheet in March, and we stopped it in July. In response to the funding pressures in money markets that emerged in mid-September, we concluded that it would be appropriate to maintain over time a level of reserve balances at or above the level that prevailed in early September of this year. To achieve this ample level, we announced on October 11 that we would purchase Treasury bills at least into the second quarter of next year, as well as continue temporary open market operations at least through January. These actions are purely technical measures to support the effective implementation of monetary policy as we continue to learn about the appropriate level of reserves. They do not represent a change in the stance of monetary policy. In particular, our Treasury bill purchases should not be confused with the large-scale asset purchase programs that we deployed after the financial crisis. In those programs, we purchased longer-term securities to put downward pressure on longer-term interest rates and ease broader financial conditions. In contrast, increasing the supply of reserves by purchasing Treasury bills only alters the mix of short-term assets held by the public and should not materially affect demand and supply for longer-term securities or financial conditions more broadly. Thank you. I will be happy to take your questions.
Michael McKee with Bloomberg Radio and Television. So I guess the question is this it? Do you consider rates to be accommodative enough now to achieve your goal of sustaining the expansion? And as far as Global Wall Street's primary question, what kind of change in the economy would cause you to reassess some sort of significant deterioration in what?
So what we've said, to repeat, is that we see the current stance of policy as likely to remain appropriate as long as incoming information about the economy remains broadly consistent with our outlook. And we say that really because both of the performance of the economy and the stance of policy. The performance of the economy has been, particularly the household sector, has been strong, has been resilient, with low unemployment, attractive levels of job creation, wages moving up, labor force participation moving up, household confidence, and solid gains in many measures of consumer spending. The manufacturing sector, particularly manufacturing and also investment in exports, have been weaker, but overall we've seen moderate growth, a strong labor market, inflation moving up. We see the outlook as for more of the same. We also see the risks to the outlook as perhaps having moved in a positive direction over the course of this intervening period, although some things remain to be seen. So that's the economy. Turning to policy, we've moved the stance of policy over the course of the year to a more accommodative stance. And after cuts at the last three meetings, the federal funds rate is now in a range between 1.5% and 1.75%. We feel that policy is well positioned to support the outlook that I described. So you ask what it would take, to move, and as I mentioned, we're going to be watching all factors, and if developments emerge that cause a material reassessment of our outlook, we would respond accordingly. But that's what it would take, a material reassessment of our outlook.
If I could follow up, if the markets decide that you need to cut rates again, will you be forced to follow?
We'll be looking at a full range of data about the economy and about the risks to the risks to the outlook. And I've given you a sense of what our outlook is. It's for moderate growth, a strong labor market, and inflation near our 2% objective. If something happens to cause us to materially reassess that outlook, that's what would cause us to change our views on the appropriate stance of policy.
Heather?
Hi, Heather Long from the Washington Post. You just said that the risks to the outlook are moving in a positive direction. I'm wondering if you could specify, is that on trade or there are other matters? This morning, we obviously learned that we've now had 2 quarters of contracting business investment, which would seem to be moving the outlook in the other direction.
So in terms of risks, what I was referring to there, the principal risks that we've been monitoring have been really slowing global growth and trade policy developments, as well as muted inflation pressure. So I was really referring there to trade developments. We have that phase 1 potential agreement with China, which, if signed and put into effect, could have the effect of reducing trade tensions and reducing uncertainty, and that would bode well, we think, for business confidence and perhaps activity over time. So that has the potential for being an improvement in the risk picture. Brexit, I would say as well, it appears that the risk of a no-deal Brexit seems to have materially declined. I think on both situations, there's plenty of risk left, but I'd have to say that the risks seem to have subsided. You ask about business investment, and that's right. Business investment has been weak, and today's reading was weak as well, and it was broad across equipment and other parts of all parts of business. Fixed investment were weak. That's consistent with what we've seen. But that's the economy we've had this year. What we've had is an economy where the consumer is really driving growth, and personal consumption expenditures were almost 3% in this quarter, in this first reading for the quarter. So overall, we see the economy as having been resilient to the winds that have been blowing this year.
Can I just follow up quickly? I mean, there's this concern that I sometimes hear that with businesses have cut investment, and are they going to turn around and cut employment? Sort of if they continue to be concerned. Can you give a sense of how the committee is thinking through that possibility?
Yes, so that is a risk. That's a risk that we've been monitoring, but we don't see it yet. We don't see rising initial claims or layoffs or anything like that. But the risk you mentioned of the weakness in the manufacturing and export and business investment parts of the economy getting into the consumer side of the economy, we really don't see that. What we continue to see is good job creation. Unemployment has declined again, and the household survey is now at a 50-year low, has been at very close to 50-year lows for 18 months now. So it's a very positive. The consumer-facing companies that we talk to in our vast network of contacts report that consumers are doing well and are focused on the good job market and rising incomes, and that's their principal focus. So that is the thing that's pushing the economy forward, and it doesn't seem to have been affected so far by weakness in the other areas.
Gina Smilik, New York Times. Thanks for taking our questions. So you've previously sort of compared this rate cutting cycle to the insurance cuts in the 90s. And in both of those instances, the Greenspan Fed took those cuts back after a while. They raised rates again fairly quickly. And I guess I'm just curious what the onus is for doing that in this cycle. What would make you guys decide it's appropriate to raise interest rates again?
So the reason why we raise interest rates is because we see inflation as moving up or in danger of moving up significantly. And we really don't see that now. Inflation moved down in the first quarter of this year. We thought that was due to some extent to idiosyncratic or transient factors. That turns out to have been the case, so it's moved back up. But it seems to be settling in below 2%. So we really don't see that risk. And inflation expectations have also kind of moved down and sideways, both surveys and market-based over the course of this of really the recent months. And we think that inflation expectations are very important in driving actual inflation, and we're strongly committed to achieving our 2% inflation objective on a symmetric basis. We think it's essential that we do that. So we're not thinking about raising rates right now.